Smith alongside Brad Smith, and this is Yahoo Finance's flagship show, The Morning Brief. Stock futures edging higher this morning, coming off a record-setting week for the market. The Dow crossing 40,000 for the first time, and we will see if Nvidia's highly anticipated earnings results can keep the momentum alive.
Plus, some fresh Fed speak on deck. Fed officials Michael Barr and Christopher Waller are set to speak any moment ahead of minutes from the central bank's May meeting later this week. Investors are closely watching for any indication of policy timing in today's commentary. So let's get right to it with the three things that you need to know this Monday morning, your roadmap for the trading day. Yahoo Finance's Jared Blickery, Brian Sozzi, and Madison Mills have more.
Stock futures muted after notching record highs last week. Markets rallied over signs of cooling inflation, prompting markets to grow more optimistic over the prospect of the Fed's interest rate cuts. Now, the central bank's latest minutes are going to be released Wednesday afternoon, giving investors more clarity on the timing of rate cuts.
Plus, markets brace for Nvidia's highly anticipated earnings results and guidance. The AI chip darling is announcing its fiscal first quarter earnings results after the closing bell on Wednesday, capping off reports from America's biggest tech titans. Wall Street believes Nvidia grew its earnings by more than 400% year over year, while revenue likely increased 242%. So far, Nvidia's stock has skyrocketed over 87% this year, easily outpacing rivals Intel and AMD.
And we'll get a check on the pulse of the consumer. We have Macy's, Target, BJ's, and Deckers reporting their quarterly reports as earnings season nears its end. Investors are going to watch the retail names closely for any signals about how consumers are faring against inflation.
All right, strumming guitar for a jam-packed week here. A busy one for Wall Street as futures move higher 30 minutes ahead of the opening bell. There you're taking a look at the Dow, the S&P 500, and the Nasdaq. The Dow closed above 40,000 for the first time. We saw that at the end of last week. The next big test for markets this week, Nvidia's earnings, ticker symbol NVDA, going to be in focus here. So a lot going on there. We're taking a look here at the touch screen at some of the big earnings reports that are set to come forth. One of the other big themes that's going to be at play, retail for sure here.
Yeah, exactly. We will really get a good read on the consumer this week. You're seeing it up there on your screen. We've got Macy's coming out tomorrow, Urban Outfitters, but then also Target. That's going to give us a better sense maybe and reaffirm some of the trends that we heard from Walmart last week. And then looking ahead, BJ's, Deckers, and Ralph Lauren. That, of course, will round out really what we were seeing in terms of consumer and whether or not it's going to further show us that consumers continue to pull back on their spending in the face of higher inflation, or a sticky inflation, I should say. But really, Brad, what it comes down to for the markets this week, it's all about Nvidia. That's going to be after the bell on Wednesday. That is going to be the real focus of the market this week. And you can see the year-to-date gains of nearly 87%. And this is a stock that has shown a bit of a slowing here as of late, but again, lots of questions about whether or not they're going to knock it out of the park once again this time, exactly what they've done over the last several quarters in a row, and whether or not they can live up to those higher expectations too, and also what it means just for the broader market as well.
Yeah, absolutely. The broader market been trying to ride the coattails, if you will, of this broader AI trade and the number of mentions. We're going to dive into that just a little bit later on. We've got an interesting chart to bring your way. Just one more thing in terms of the mentions that we've seen over the course of this earnings season. You mentioned inflation a moment ago. That could show up in some of the retail earnings. Inflation mentions. The number of S&P 500 companies citing inflation on earnings calls for Q1 2024 is still well above the 10-year average of 180 here. So that, from FactSet, that's going to be another interesting thread that continues to be woven over the course of this week.
Yeah. Consumers are paying more, and they certainly are noticing. All right, let's talk about Nvidia because it's led the charge once again this year. Shares up nearly 87% since January 1st. So can the chip giant sustain its momentum? Here to break it all down for us, we want to bring in Patrick Moorhead, More Insights and Strategy founder and CEO. Patrick, it's great to see you again. So talk to us just about what you're expecting to hear from Nvidia this week and whether or not you think it's going to live up to those lofty expectations.
Yeah, so every quarter we do this hand-wringing process because, as you said in the run-up, the stock has actually crushed it over the past year and a half here. So you have to be cautious about when is something going to happen. And I believe that, like we've seen the previous multiple quarters, the company is going to clearly beat expectations on top line and EPS. and we'll likely see a very positive guide. And I base a lot of this analysis on two or three core things, which is look at demand. Demand is off the rails. What's development risk? Somewhat low because Blackwell is very similar to the previous chip they had. And then there's manufacturing. There could be some risk in manufacturing from TSMC, and that would be the place to look.
Patrick, how long can other companies ride the coattails of Nvidia's AI demand mentions when they talk about just how much they're anticipated to continue to grow as a result of this newfound, perhaps, well of demand for generative AI?
There's going to be multiple AI infrastructure build-outs. And the first one we're seeing is amongst these hyperscalers, right? The Microsoft, the Googles, the Amazons. And that has at least another 18 months in it. And then what we're going to see is it branching out, which is to businesses and on-prem data centers. And you're going to see companies like Dell and IBM and HPE. And then you're going to see this PC wave, which interestingly enough, I think kicks off this week at the Microsoft Build Conference. And then you're going to have the smartphone AI build out. So there is a lot of room in this AI run up just on the infrastructure side, not even talking about the software and services.
Yeah, Patrick, talk to us a little bit more about the software services, the opportunity there, and then just in terms of those lofty expectations, kind of going back to what you started that first answer with, what do investors need to understand just about what that growth rate is going to probably look like from here on now if we do see a bit of a slowdown from those blow it out of the park type of numbers that we have certainly seen over the last several quarters?
Yeah, so related particularly to NVIDIA, I mean, you're going to see deep double-digit numbers, but for the rest of this build-out, we really haven't seen the pop, right? We saw a little bit of double-digit from companies like Amazon's AWS, right? You see markers like ServiceNow that are absolutely crushing it, but I think double-digit growth is in the cards, worst case for these companies.
You know, it's interesting because going forward from here, and especially looking throughout the rest of the year, a lot of companies who have either implemented plans for generative AI and plans to have it increase their workplace productivity or even to give solutions to customers. A lot of the central force and focus right now has been around some of the tech companies like where even Apple might be able to infuse this into their products as well. Should customers expect some massive wave of generative AI in consumer devices by this year?
Yeah, the short answer is yes. Today, we're going to see Microsoft talk about their AI PCs and what they're doing and how they're supporting it. We've seen Qualcomm get out there and talk about the AI smartphone. They announced a smartphone chip for that. We saw Samsung with the S24. We're going to see Apple play their card at their WWDC developer conference here in June. And I do believe that, and I'll repeat what I've said on your show and others, I'm expecting the start of a super cycle in the fourth quarter for these AI devices, which will inherently have generative AI capabilities.
So what does that mean then for these stock prices then, Patrick?
I think they have nothing to do but go up. I don't think they're baked in, particularly when it comes to companies like Apple, HP, Dell, and even Lenovo and Samsung.
All right, Patrick Moorhead, who is the More Insights and Strategy founder, CEO, and chief analyst. Patrick, great to kick off the day with you. Thanks so much for taking the time.
Thank you.
Absolutely. Well, Nvidia might be seen on Wall Street as the bellwether for the AI trade, but it's not the only player. Beyond the big tech names like Microsoft, Alphabet, and Meta, other sectors are attempting to ride the coattails of the AI trade. And this is what we teased at the top of the show here, the number of mentions as well from some of the other sectors. And it's quite interesting, especially as you branch out and look even beyond information technology and communication services. Even energy getting into this AI talk as of right now, this earnings season.
Yeah, exactly. And we bring this up just because this really highlights how critical, how crucial the AI trend, the AI trade is for the overall markets. When it comes to Nvidia, obviously by far seen and is the leader within the space. So I think any sort of hints just in terms of future growth, what that growth rate is going to look like, that certainly is going to set the tone here for the entire sector when it comes to tech, when it comes to AI, but then even beyond, because Brad, like you were just saying, the number of mentions of AI from other industries has steadily ticked to the upside here. And you can see it, you're right to highlight energy, just because when we talk about that next phase, almost talking about what Patrick Moorhead was just telling us there a couple of minutes ago, energy playing a critical role in terms of the AI development, the AI rollout here in terms of that next stage. So no surprise that we are seeing more and more companies, 66% of companies within the energy sector mentioned AI during their earnings calls this quarter. That was up from just 19% last quarter. So that is a dramatic move to the upside. And like David Costin over at Goldman Sachs and his team, we're talking about that this just shows that AI has certainly soared here in terms of mentions amid this broadening of the AI trade. So we talk about a bit of a rotation that certainly seems to be playing out within earnings results, and investors are taking notice as well.
And here's the tune to which they're taking notice. S&P 500 companies citing AI on Q4 earnings calls. They saw an average stock price increase of 28.6% in the past year, according to FactSet. So that takes you back to the previous earnings period. 179 mentions of S&P 500 companies of the term AI during that same quarter here. And so if we continue to see this be a theme that companies tap into, not only here in Q1, but going forward for Q2 results, Q3 results, it's also going to be a question of, okay, when is it going to actually show up and be accretive to the businesses here and be realized as revenue and into the margins? And I think that's what investors are going to start pounding the pavement over later this year.
Yeah, exactly. And I think also the big question is how much of this is already baked into some of these prices, how much is not? Even going back to what Patrick Moorhead was just saying when he talks about that fourth quarter, that super cycle that we will likely see, how much of that has already been reflected? He's making the argument that there's certainly much more room to run. So I think investors are trying to figure out just what makes the most sense. Is it these secondary players that will likely maybe potentially see the most run rate and the most growth to the upside here in the secondhand adoption story? But I don't know, we'll see.
Yeah, I mean, as soon as I can notice the difference between my iPhone pre-generative AI and post-generative AI, then I'll be super excited about this right now.
All right. Let's turn to a developing story that we are closely tracking overseas. Iranian President Ibrahim Raisi and the country's foreign minister were killed in a helicopter crash, the state's media reporting earlier this morning. Just hours after Raisi's death, Iran's supreme leader ordered that 5 days of national mourning, while also appointing Mohammad Mokber, Iran's first vice president, as acting president. For more on how the markets are responding to this news and really what this means more broadly speaking, we want to bring Yahoo Finance a senior columnist, Rick Newman. Rick, it's good to talk to you here. So just talk us through just what we know at this point, and then also the next steps. What is next here for Iran?
Well, Raisi was broadly viewed as the possible successor to the supreme leader. So in other words, possibly the next leader of Iran in that theocratic government. And obviously that's not going to be the case anymore. He died in a helicopter crash. I guess if there's any good news here, guys, it's that nobody is saying Israel did it. I mean, when I heard about this, before it was all confirmed, my first thought was, wow, is there any chance that Israel had something to do with this? Apparently not. It was just an accident. So that's a good thing. So no effect on the, what is this war or shadow war, if you want to call it that, between Iran and Israel, and also no effect on oil markets. It's not going to change anything about oil supplies. So it will change the picture for who is the next leader of Iran. It's quite notable when you see some Iranians celebrating the death of one of their top leaders. This guy was not popular. One of the things he's best known for is running these death commissions going back to the 1980s and 1990s, political activists, people involved in the Iran-Iraq war put to death and so forth. So there's going to be perhaps a leadership struggle in Iran, but at the moment, no broader implications that we can see.
Yeah, the U.S. Treasury Department in a 2019 sanctions announcement called it a death commission, Ibrahim Raisi's participation in that. So that sanction was announced from the U.S. a few years back here. Rick, ultimately, what should the U.S. be looking for, doing, if there is any type of kind of way forward in who this next leader is that's selected?
we don't have any say about over that.
Yeah.
I mean, this is not a democracy. It's a theocracy. It has been since 1979. I mean, the main thing the Biden administration is worried about right now, I guess you'd say two things: the price of oil. And the Biden administration has been sort of soft on Iran with regard to sanctions that are in place, sort of not in really aggressively enforcing those sanctions. So that is going to be the case, until November, until the election's over. Who knows what'll happen after November? Of course, it depends on who wins. If Biden wins again, could he tighten up on Iran? Yes, absolutely, with regard to sanctions. But we also got to get to the end of the Israeli war with Hamas. Iran backs Hamas, supports it, funds it, and basically funds anybody who wants to attack Israel. So it's just a complicated mess, and I think that for the time being, we should be relieved that this has no effect on oil markets, energy markets, or anything we have to deal with today.
Yeah, OPEC conveying their condolences on the passing of the Iranian president this morning here. Rick, thanks so much for taking the time to break this down.
Hi,
for
guys.
us. Appreciate it. Coming up, everyone, big names are still vying for Paramount's attention. Sony and Apollo Global Management have reportedly taken a step forward in their effort to court the streaming giant. We've got the details on the other side of this short break.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action
with step-by-step analysis of our biggest trending tickers
and expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is
Market Domination. Tune in daily from 3 to 4 p.m. Eastern.
Let's get to some trending tickers this morning. We're tracking shares of Paramount, P-A-R-A. They're moving higher. Sony and Apollo Global Management have reportedly taken a step forward in their effort to court Paramount and have signed non-disclosure agreements with the company here. I mean, it seems like the stock price is largely moving just entirely on the ramifications of a deal, all of the different nuances of where these discussions have been moving forward, who's dropping out, who's entering and throwing their hat into the ring. But for Paramount, at least right now, it seems like things are starting to solidify a little bit more with Sony and Apollo Global as the potential suitors for this deal.
Yeah, exactly. And I think this comes maybe as a bit of surprise since we hadn't really heard much over the last 2 weeks since it was initially reported. So I think there was questions about whether or not the likelihood of something actually materializing here. So again, the fact that they did sign this agreement, the non-disclosure agreement, certainly does show the interest from Sony and Apollo and exactly maybe what that could potentially look like here going forward. We don't have many details beyond that, but I think the question that a lot of people are asking right now is why Sony and Apollo potentially are interested in Paramount and what exactly that would look like. Lots of talk just about Sony obviously focusing on the studio part of the business. When it comes to Apollo, many industry players saying that they would certainly be and they are interested in the studio lot as a real estate play. So certainly some interesting aspects of that to keep in mind. And again, remember that this comes just 2 weeks after Paramount's negotiating window with Skydance ended without a deal. So lots of questions about what the future of Paramount is going to look like. Obviously, we also have the shakeup at the top with the departure of Bob Bakish. So I think a lot of investors right now are trying to figure out who is most likely to buy this company and then exactly the disruption or the impact that that is going to have on the industry at large.
Yeah, absolutely, especially when it's come with this broader kind of rebundling effort that's started to be initiated on the sports side as well. And so with all of the different rights that are getting gobbled up, NBC and NBA, and then of course now recently Netflix doing more to make sure that it has a hand in sports as well. I mean, my goodness, this Tyson, Jake Paul, I don't even know if we should call that a sanctioned fight, but I'll leave that for whoever's out there and whoever wants to watch. But with all of these players contributing and competing more for some of the sports rights, and Paramount now just banking on potentially a bundling and focus in on those studio lots, it's also a question of what type of free cash flow this business would have a profile of, especially if you're spending big on these major blockbusters that are going to have to make the decision of, okay, do we go straight to streaming or do we also put this in theaters and hope it does well there and then add it onto streaming later on? I think that's the juggling matter that's going to come place regardless of when this deal nets out.
Yeah, certainly. All right, let's take a look at another mover here this morning, and that is Li Auto. Shares are under pressure after reporting that its first quarter net profit fell 36% from a year ago. Steep rise in research, hiring, new staff, and other operating expenses offsetting some of the higher sales that the company did see. It also cut the prices, though, across the board of its vehicles last month as it continues to face intense pricing competition. Remember the likes of Tesla, BYD, XPeng, obviously putting some pressure on this name. But when it comes to what we just heard, we also want to call out the delivery numbers because I think that's critical to talk about here. When it talks about Li Auto delivering 80,400 vehicles in Q1, yes, it was up just over 50% from levels a year ago, but it was down nearly 40% versus the levels that we saw in Q4. So I think that highlights some of the softening that we're seeing within China's market. And then also just in terms of questions about what the current demand looks like when it comes to the current quarter and the rest of the year, maybe the pressure that we could see beyond Li Auto when we're talking about some of those competitors.
Yeah, and that's especially where it kind of brings into mind some of the year-over-year comps and how they might not actually be as much of a pulse on the state of the EV market right now as much as the kind of quarter over quarter, which you saw a decrease in vehicle sales quarter over quarter of about 40% here versus the fourth quarter of 2023. And then additionally, you look at the vehicle margins, that came in at 19.3% in the first quarter of 2024. You compare that with a 19.8% margin, so larger than this most recent quarter in the first quarter of 2023. And then, yeah, look back to the fourth quarter of 2023 as well. That was 23-ish% there. So declines in margin, declines in vehicle sales right now. And I think just coming back to your point of exactly how this business is going to be able to continue to operate right now and make sure that they can ensure investors that they are going to maintain this profit margin as well. With this kind of waning demand that we're seeing right now, it's really going to come back to the incentives that they're offering as well in the competitive landscape, because that's what we're seeing too now from some of the auto manufacturers.
Yeah, very true.
Also, we got to talk a little airline. So from the roads to the skies here, low-cost airline Ryanair reporting its best ever annual profit, passenger and revenue growth, offsetting higher operating costs here. The airline served 184 million passengers, 23% more than the COVID pandemic. Shares, they're down. Why? Well, there's quite a bit to kind of dive in on here. Of course, some of the comps might not exactly be apples to apples here, or at least, oranges to oranges if you're looking at a big orange versus a clementine. Anyway, all of the foods aside, I'm getting hungry. I think one of the huge things too is the Boeing impact that this company talked about here. They were ultimately seeing traffic grow, sure, 9%, but the average fare rose 21% as well. They're citing a record first half, strong Easter traffic in late March. So that's where it's kind of oranges to clementines too, because you have a little bit different of a pie that you're looking at, just the food references this morning anyway, offset by softer than expected third quarter fares and load factors as well. But this is still a company that did have to announce some impacts because of Boeing too.
Yeah, and I think the travel numbers here for this summer are in question when we're talking about demand, the inflationary pressures that so many of consumers are feeling right now. And that was also called out by their CEO. When it comes to what some of the trends that they are seeing, bookings for the summer, they're ahead of last year, though fares were not as high as it had expected. So that's something that analysts are very closely watching, whether or not we are going to see a tick up in airfare for this summer, as many people have yet to book. Something that Ryanair also called out on this earnings print and on the call. But I think when it comes to the demand story, right, that is really what is in question for so many of not even the low-cost carriers, but really even the larger domestic carriers here in the U.S. Just what exactly that demand is going to look like as we have this return to normalization. We've seen pent-up demand over the last couple of years because of COVID. Now it seems like we are transitioning into this new normal. How much pressure that could ultimately maybe put on fares here going forward, I think is one of the things that people are trying to figure out at this point.
Yeah, big European energy from this company here. Travel demand in Europe, they're saying, is strong for the summer 2024. And despite the Boeing delivery delays, they're going to operate their largest ever summer schedule. Over 200 new routes, coming back to that capacity point.
Yeah, and they sounded a bit optimistic just in terms of the improvements that they're expecting to see here from Boeing at this point. All right, we are just minutes away from the opening bell on Wall Street. Keep it right here. We'll be right back.
All right, we're taking a live look at the opening bell at the New York Stock Exchange. You've got Contour ringing the opening bell there. KTB, yeah, you know me. All right, well, anyway, we're going to be speaking with that company a little bit later on today. Plus, you've got another company ringing the opening bell at the Nasdaq. So good, so good. I got you. Somebody got it. All right, well, anyway, sad day in New York here as the Knicks lost last night. So let's take a look at some happy markets. Let's do a quick check of the markets here as we're taking a look at the Dow. Sad right now. It's flat, barely to the downside. S&P 500, that too, well, that's flat, just barely to the upside here. And the Nasdaq Composite making up its mind, deciding it wants to start off the day positive here.
Yeah, Brad, when you take a look at the sector action here, we are seeing things shake out just a bit. It is certainly a mixed picture, similar to what we're seeing play out in the major averages. You've got energy industrials leading the way early this morning, communication services, consumer staples, and real estate lagging behind. But I think the market's really going to be focused on that event that's happening after the bell on Wednesday when it comes to Nvidia's earnings, potentially here setting the tone for the markets going forward. But as we have seen record-setting moves here for the market as of late, you also got to take a look at what's happening within the commodity market, because gold right now hovering near its record high amid rising geopolitical tensions. Let's get to Yahoo Finance's Jared Blickery, who has a closer look at the movement that we've seen. Jared.
Guess what? Another record high in gold and copper. It's given back some of those gains overnight. You can see just barely above the unchanged. However, check out this year-to-date chart, and I'm going to compare some of these markets. Here's what we've seen year to date. Only recently broke to the upside there in gold futures, but I want you to see what's going on in the longer term. This is a 4-year consolidation that goes back to the beginning of the pandemic. We broke out this year. If you take a look at copper, that's HG equals F. That's a very similar story, although it was camping out at the bottom end of its range until very recently. But copper at another record high. If you take, a lot of people follow the copper to gold ratio, that's approaching 4.5, and so that's an historically extended and stretched. So we'll have to see if copper futures can still maintain that rally with respect to gold. But I'm also tracking silver. Now here's the 5-year on silver. Again, a 4-year consolidation, only recently breaking to the upside. So the point of this is to show that when you have a long consolidation period, the gains from that, the momentum that you have to the upside, generally tends to last for a protracted period of time, leading some to say that we are at the beginning of a new secular bull in certain commodities. Also want to touch on crude before I go. Let me just show you the year-to-date chart. Really, crude hasn't been doing much for the month of May. It's just been kind of quiet, camping out below 80, but we're going to be on alert for some OPEC headlines within the next week or two and see what they're up to. Guys.
All right, Jared, thanks so much for breaking that down for us. We want to get to one of the trending tickers here on Yahoo Finance. Shares of digital pharmacy Hims & Hers surging this morning after announcing access to GLP-1 weight loss drugs. The company planning to price a compounded injection starting just around $199 a month. So when you take a look at the reaction that we're seeing play out in the market right now, you're looking at shares up nearly 11% here at the open. When it comes to what we are learning within this news here, clearly this could be a huge win for the company going forward when it comes to exactly what this means here for Hims & Hers. The firm saying that the treatment offers the same active ingredient as GLP-1s and Wegovy copycat drug made by undisclosed compounding pharmacies. So it's an important difference here that we do want to note. But again, the street is excited about this, and you're looking at gains of nearly 11%, Brad.
I mean, we're getting to the point where we're starting to see advertisements for some of the solutions. Move over wearables and embeddables. I guess this is an embedded technology, if you will, the injectables. But ultimately for Hims, Hers, and all of the other businesses that are trying to make sure that they don't miss out on the GLP-1s, I guess where do you reinvest some of those profits is going to be the next question for investors to make sure that you're ahead of the next R&D development or R&D phase, research and development phases for. I don't know what people decide to do after this, but once you've lost all that weight, you got to figure out something.
Yeah, you do. And then that's the other part of this conversation too, just in terms of what that demand is going to look like going forward, exactly what what happens when people do get off these drugs, if they do decide to get off these drugs. But Hims & Hers at least seeing a reason to try and get into this space surrounding the hypes, and the company saying in the press release that that this is going to help customers access these drugs without, quote, navigating the shortages and costs that are currently limiting access to the branded medications here. So again, shares jumping just about 15% in early trading. All right, major U.S. indices hovering near closing record highs. This ahead of Nvidia earnings out on Wednesday. A lot is riding on this report. You've got the chip giants accounting for about a fourth of this year's return on the S&P 500 so far. We bring that up because of Nvidia, and we've got Nvidia reporting results after the bell on Wednesday. Here to break it all down and what this means going forward, we want to bring in Randy Frederick, founder of RandyFrederickMedia.com. Randy, it's great to have you here. So talk to me just about what we are seeing here when it comes to the fact that we are at record levels. Lots of focus is on Nvidia right now. How important is this earnings print to the overall market?
Well, NVIDIA has been important for a very long time. Obviously, everybody's familiar with AI. It's still in its infancy, but it's not going away anytime soon. And I think many people, and I share this opinion, AI is going to change things as much as the internet did when it came about 30, 40 years ago. So that's very, very important. And as you said, it's been a key component to the overall growth in this market. But as Jared was talking about earlier, there are a lot of signs that show that things are doing quite well, but oftentimes things get just a little bit ahead of themselves. And I think we may be at that point right this minute.
Is there a risk to the overcrowdedness that we're starting to see in some of the generative AI trade right now?
There's definitely a risk there. And again, remember back in the year 1998, 1999, 2000, when just about every company in the world added .com to their name so that everybody could pay attention to them. And then many of their stocks doubled, tripled, quadrupled, went up 100-fold even. This kind of thing is happening to some extent now. You've got a lot of companies that have changed their name to AI, something AI. It's in there somewhere. Or they talk about, oh, yes, we do AI too. But it's really important to sort of separate the companies that talk about AI and say, yes, we'll be involved in AI, to those that are actually creating it or actually using it to do things for real. And you really have to do research to make sure that you know the difference. NVIDIA is obviously a company who is doing AI. They're creating hardware that makes it work. But a lot of these other small companies that talk about it a lot, in many cases, it's just a Me Too pile-on to sort of get some attention. That's important for investors to do real research from reputable sources to make sure that they get this information. You know, talking to some 22-year-old on Reddit is probably not the best place to get investment advice about things like this.
Randy, if we do see Nvidia miss the mark, though, how big of a narrative change could we expect then for the broader market?
It's probably not as substantial as you might think. I mean, it's definitely going to hurt that stock, but it's got a lot of upside that it could give up a whole lot of that and still be way ahead of itself. Because even a weak quarter is not going to make AI go away, and it's not the end of the world. It's still going to continue. So even if things get a little bit overheated, and so there's a reset or a correction, almost like you would see in the stock market in general, not a terrible thing. It's probably a one-quarter setback. And in fact, we've seen this in a lot of companies. They'll have a weakness for a month or two. In the long run, I would look at things like that as buying opportunities. That doesn't mean borrow all the money you can get your hands on, back up the truck and buy everything, but it's a really good opportunity to either add a little bit to your position if you have one, or if this is something you've been looking at doing, you need to probably add a position when those types of things happen. Right now, the market's at an all-time high, or just a couple of points away from it. You've got to look for opportunities to buy when we have dips. And as I said, I think we're probably due for one right around now.
Randy, I'm taking a look at some data from Options AI that is showing an implied move or an expected move of about 9% post-earnings here. What would this company need to come out and say about not just the earnings and revenue for the last quarter, but the guidance for the rest of this year and how much legs are still left within this broader demand profile that they're seeing right now for generative AI that's added an entirely new catapult to their own success?
So two things to point out. One, the options market is pretty good about predicting the movement of stocks, but keep in mind that when you say 9%, that's to the upside or the downside. Options don't necessarily predict direction. They predict volatility or the amount of movement. So you could see that big of a move to the upside or the downside. The company basically just has to continue to do what it's been doing all along to show that it's executing, to show that it's developing, to show that it's continuing to make forward progress. But again, if for some reason the data isn't outstanding, and again, the expectations are very high, then perhaps there would be a little bit of a pullback. But to be quite honest, I mean, the majority of my career was based on reading the tea leaves of the options markets and to some extent the futures markets And those types of forecasts are actually pretty accurate in the longer run.
So, Randy, where are you seeing that investment opportunity right now, given the fact that you think we are due for a bit of a pullback? Maybe it makes sense then for investors to put money to work then, but where?
Well, the reality, yes. Again, so the whole expression that you've heard many, many times over many, many years of sell in May and go away, surprisingly, it's not entirely accurate, but there's an element of truth to it. So the belief that you should get out in May and then come back in September is false. Yes, the market does perform less well between May and September than it does between September and May, but in the overall long term, it's not a negative period of turn. It's just a slightly lower positive period of return. But if you look at what's happened in the month of May, and I've studied these numbers, I shared them with you, for the last 24 years, we've had a decline in May, 23 out of those 24 years. Sometimes it was as little as just 2%. Sometimes it was substantially larger than that. So far this month, we've only had one downturn, and it was about 1.5%, and it happened, at the very first or second day of the month. There's a very good probability, based on historical trends, that we will see a dip here over the course of the next couple of weeks. Now, that doesn't mean that I'm bearish in the medium term or even in the long term. In fact, I think in the end of the year, the S&P 500 is going to be a couple of hundred points above where it is right now. But this is where you look for opportunities. If we get this pullback, as I expect over the next couple of weeks, that's, again, an opportunity to add to positions that you own, that you like, or to potentially take on positions that you are interested in. And frankly, the sectors that have been performing well so far this year are likely to continue to be the same ones that go forward. The ones I would be cautious about are things like real estate that are already underperformers.
Randy Frederick, who is the market strategist and founder of randyfrederickmedia.com. Randy, thanks so much for taking the time this morning.
You bet. Thanks for having me.
Certainly. Guys, coming up, copper futures are 25% higher this year. Is it a time for a pullback here? As we're taking a look at the year-to-date move, 29%. My goodness. Okay. All right. We don't want to be the naysayers, but that's next.
Copper prices are surging to record highs. We certainly have seen a lot of buying action when it comes to commodities. When you take a look at the price of gold, gold futures also up 16% on the year. So is now a good time to get into the raw material space, or are we set to see a pullback soon? Joining us now, we want to bring in Michael Widmer. He is Bank of America Global Head of Metals Research. Michael, it's great to talk to you here. So first, let's start with this massive run-up that we've seen in the price of copper. Is that going to slow down anytime soon? And if not, how high could we see prices climb?
I think there's two elements to that massive run-up. I think the first really is a kind of a supply element here, and you see that in the chart that you're putting up there. The rally actually started earlier this year. I think that was on the back of announced production cuts by Chinese smelters and refiners, on the back of very tight mine supply. That story, I think, still stands. I think the rally over the past a few days was really down to a short squeeze on CME that has then spilled over into other exchanges. I think on the latter one, look, short squeezes normally resolve themselves, and then you see reduced upside. So I think that's something that is potentially kind of putting a little bit of a hold on the immediate rally. But overall, look, I think the structural bull case for the copper market remains in place. So when I look 12, 18 months out, do I think the price is straight higher compared to where they are right now? Absolutely.
So if we do see normalization within this trade, what does that look like from a price action perspective?
I mean, look, we have prices actually below 10,000 for the current quarters in terms of our forecast. So about 10% below where they are right now. But this is firmly a buy the dip market. I think what we need to see at this junction is maybe a little bit stronger Chinese demand, maybe a little bit stronger demand from the Western consumers as well. And if that comes through, I think if we had a dip now, that would take us then very swiftly back up. It is a buy the dip market. And then 2025, we have an average price forecast of around $12,000 per ton. So that's about 20% above the spot levels where we are right now.
What industries would you need to hear are prioritizing production within China in order to have a sense of confidence that that region was going to step in with larger purchases for copper?
It's actually a very bifurcated market at the moment. So you have got the green industries, which have carried the copper market in China. So that's solar, that's wind, that's the EV side of things. And then a lot of the traditional economy, like the housing market, actually subtracting from the copper demand. So what would make me much more comfortable at this junction is if you continue to see the green spending coming through, while we have a little bit of a lower drag from the housing market. And that's something that hopefully, so the grid is coming along nicely. The housing market is a lot of measures now being put in place that hopefully slots into place too. And then I think we have a stronger market going forward. Sentiment, I think, is really important for the wider economy. I think one of the reasons why demand also remains subdued in the traditional economy is that there is a lack of confidence in the economy, and that has been the case in the end of COVID.
Michael, when it comes to the outperformance that we've seen in copper relative to gold, when it comes to that ratio, the loftiness that we're seeing there, is that something that you think can continue, or what do you think that gap then is going to look like from here on out?
It's an interesting question, because what we have seen actually across a lot of the commodities is that some of the traditional relationships have started breaking down. So last year, for instance, look, copper should have traded a third below the level where it was, but it didn't. Taking PMIs, for instance, as a reference point, but it didn't, because we actually had that energy transition spend. So this is a very different copper environment. We have a structural support, a structural bull case for the copper market. So on that angle, and keeping in mind the dislocation that we already saw last year, I think that ratio can continue to dislocate. I think copper looks fundamentally over the next 2-3 years very strong.
You know, with that in mind, I guess that would fade any risk from the year of global elections that we're going to be watching this year. I mean, is there anything that could upend the import-export equation right now for copper, at least from a geopolitical perspective?
Yes, and I think that's something that we have to follow quite closely. I think trade disputes are never great for global growth. Granted, when you're looking at the U.S. economy, investment in non-residential construction has been very strong. Car production stage was very strong, and a lot of that has been linked, particularly on the construction side, to the Biden policies. Now, if we are if you continue that reshoring or that onshoring, I think that investment will come through and ultimately also the manufacturing demand. But if that reshoring comes, as we increasingly see now with trade disputes and tariffs and barriers, then ultimately that will have an impact potentially on global growth. And I think it will have an impact if China is on the receiving side on that initially on potentially the sentiment in China. So the way all of that plays out is worth following. I think what we hear at the moment in the US is there's a broad bipartisan support to push back against some of the Chinese dominance. And that makes it even more important to follow quite closely what's happening.
Thanks so much for taking the time here today. Michael Widmer, who is the B of A Global Research Head of Metals Research. Appreciate it.
Thank you.
Thanks. Coming up, everyone, one of Wall Street's most bearish analysts changing his tune. We're going to discuss that next. One of Wall Street's most prominent bearish analysts changing his tune. Morgan Stanley's Michael Wilson, who previously predicted that the S&P 500 would be down 15% by December, now boosting his target from 4,500 to 5,400. That puts his forecast more in line with some of the most bullish Wall Street analysts. As recently as last month, Wilson said he was staying away from making any big calls due to economic uncertainty. And there you're taking a look at some of those other bullish S&P 500 year-end forecasts. I mean, the bullish tenor, the loverade instead of the haterade, if you will, is certainly flowing heavily on the street today. Yardeni research out with a market call from Dow 40,000 to infinity and beyond, channeling Buzz Lightyear there. So there is a lot of positivity that's flowing right now on the street.
There is, and I think a lot of people were waiting for whether or not Mike Wilson and his team were going to come around to really see what the market's momentum is and whether or not he was going to upgrade to a certain extent 20%. That might have taken some people by surprise, but he lays out compelling reasons as to why he's coming around and now seeing higher highs, at least, or now seeing, I shouldn't say that because he actually sees 5,400, so not much of a move here to the upside. But when it comes to why he is now seeing a more than 20% move to the upside than what he initially saw previously, it's backed by that robust outlook for corporate earnings, a theme that we have been talking about time and time again. Where he's seeing those investment opportunities right now, they upgraded industrials to overweight. They write given improving earnings revisions and structural drivers that they believe the recent underperformance offers an attractive entry point there. And then also they maintain long exposure to certain defensive areas to hedge against the risk of slowing growth. So bit of a bearish tone, maybe a little bit within this report with the consumer staples, utilities in particular. We certainly have started to see those two sectors catch a bid here with investors over the last couple of weeks, in particular utilities. You and I have talked about it a number of times. So again, the street getting more and more bullish here in terms of that upside projection before the end of the year. Mike Wilson definitely turning a bit more bullish, far though from being the most bullish on the street, clearly.
Yeah.
That would have been quite the reversal.
I think the remarkable thing is, too, we're getting these calls even ahead of the company that is said to be the bellwether, not just for the generative AI trade, but perhaps for a lot of the wind in sales in the broader markets here. And their report set to come on Wednesday, and that is Nvidia here. So these calls coming even ahead of that, and that actually points me back to what Yardeni had said within their research. The Q1 2024 earnings season is over, they say, even though we've got some retail companies, even though we've got Nvidia coming forward. And here's why they said that. Early on, the analyst consensus estimate for the S&P 500 EPS implied an increase of just 1.2% year over year for the quarter. The actual result was a 6.3% increase. So essentially saying, you know what, let's declare victory on this. Let's move forward. Let's look out to the rest of this year and continuing to look towards some of those new record highs that are potential even after this earnings season.
Yeah, and here we are today. We've got the S&P pushing even further above 5,300, closing just above that level on Friday. All right, keep right here on Yahoo Finance. Much more to come. We are going to be talking a lot more about Nvidia. Those earnings reports is out on Wednesday. We'll discuss how U.S.-China relations could impact the chip giant's latest results and ultimately what it means for their business down the line. Plus, tapping into the state of the consumer, CEOs of Contour Brands and Priceline will be joining Madison Mills and I for in the next hour. Much that and more. Catalyst is next. 10 a.m. here in New York City. I'm Shauna Smith alongside Madison Mills.
It's Monday, May 20th. Let's dive into the catalyst moving markets today. The big catalyst for the week, Nvidia earnings coming out on Wednesday. Those shares are up over 86% year to date here. Investors will be watching to see if the chip giant can meet lofty expectations. Nvidia has seen double-digit gains after 3 of its last 5 earnings results.
And the commodity rally living on. Gold, silver, copper reaching new heights as demand for the metals increase.
And Iranian President Ebrahim Raisi, the country's foreign minister, and several other officials were killed in a helicopter crash. Could this escalate geopolitical tensions in the region? We're going to discuss later in the show. But first, today's top story, investors looking to those Nvidia results again coming out on Wednesday for what could be the next big driver of the market rally moving forward here. Shares of Nvidia rose 20% after their results this time 1 year ago, with the company tripling in value since then. The big question, can the chip-making powerhouse deliver on lofty expectations? Yahoo Finance posed this question to experts over the last week. Here's what they had to say.
I think if markets wake up to say, hey, maybe we got a little bit too excited about this, and maybe we pulled forward some of these earnings just a little bit, and that's reflected in those valuations.
We can't rely just on Nvidia. Yes, we're going to buy a ton of Nvidia, but the growth opportunity is so big, we need others to help us build this as well.
It's been a key component to the overall growth in this market. But as Jared was talking about earlier, there are a lot of signs that show that things are doing quite well, but oftentimes things get just a little bit ahead of themselves. And I think we may be at that point right this minute.
Well, while one guest saying we are a little ahead of ourselves, Shauna, if you take a look at the options markets, pricing in an 8% move off those Nvidia earnings, which could move the S&P by 0.4%. That is according to data crunched by Citibank here. The street expecting huge revenue increase. I mentioned over 240% year over year. But the backdrop here is that we're seeing a lot of major indices over the entire globe here hitting all-time highs. 14 of the 20 major indices hitting all-time highs as of Friday's close. So it's possible that the market momentum is no longer relying completely on Nvidia, even though, of course, those expectations are quite lofty.
Yeah, you've got to ask if it does miss, I think to what extent, right? If it is a massive miss, you think that the street naturally would take a huge issue with that, given the pace that Nvidia has set here for the markets. But you're exactly right. When we talk about the broadening that we're starting to see within market participation, we're talking about the excitement even within AI, certainly trickling over to other industries. We talked earlier on in the last program in Morning Brief about the number of mentions of AI this quarter and what we are starting to see in industries outside of tech. And certainly it looks like we have seen a massive surge to the upside. So AI is certainly an important part of this market story. It has been over the last 18 months. You can certainly see that reflected in the strength within the market, certainly those Magnificent Seven names. So Nvidia being the poster child for AI, accounting for about 5% of the S&P's market value, third largest weighting within the S&P. There clearly is a lot riding on this report. Whether or not, though, it is a make or break moment for the overall market, there certainly is a case to be made that yes, Nvidia is very important, but if it does come in line with expectations, that might be enough for investors at least to be able to look even beyond that and see other areas of strength within the market. All right, well, major markets, they are holding just near those record highs. The Dow, though, slipping a bit. Investors taking a breather from that rally ahead of Nvidia's earnings results out on Wednesday. The chip giant is the largest contributor to earnings growth in the S&P 500. Without it, the blended earnings growth rate for the index would fall from 5.7% to 3.2%. That's according to the latest data out from FactSet. To discuss how investors should position their portfolios ahead of the results, we want to bring in Brett Ewing. He is first Franklin Financial Chief Market Strategist. Brett, it's great to have you here. So talk to us, just is this or is it not a make or break moment here for the market in the context of Nvidia earnings out on Wednesday?
Well, I certainly think that's a big component, and it's going to play an important role here in the short term with the market. But I think the AI trend is a little bit longer term, and the market will likely recover. So just from a historical perspective, let's talk about where we are in the market right here. This is an election year. I know a lot of people may not know that, but we are in an election year. If you look back, going back to 1928, markets are positive in an election year over 83% of the time versus 69% of the time non-election years. Another thing I would like to point out is that, look, we are likely in a low Fed cut cycle right here. And that is absolutely Goldilocks for stock markets. If you go back and look at all the 8 cycles going back to 1950, and you look at all the slow cut rate cycles, the average return from the very first cut is about 23%. So I throw that out there for your viewers. I think those are some important facts to look at right here.
Well, I'm curious about your thoughts on the conviction behind that momentum that you look at historically. Do you think that this is a close your eyes, hold your nose, and buy environment?
I never think that, but I do believe we have a lot of positive tailwinds. Again, with the Fed, I think over the next 2 years, we're looking at areas in small and mid cap. I think that that's one of the least talked about areas of the market. And I think the opportunity there could be upside of over 40 to 60% over the next 18 months. And, you know, small and mid cap stocks, if you look at the Russell 2000, for example, it's been in a 24-month channel. It's been in a box. It's been trying to break out of that channel. It's attempted 5 times. The 6th attempt just recently here in March, it actually broke out of that channel. Now, that's the 4th longest streak of being trapped in the channel in its history.
Right.
And the longer they stay in, the more powerful the breakout could be.
But Brett, I'm curious about your take on that, because small caps are the ones that are most likely to be negatively impacted by higher for longer, given the amount of debt that they have and the inability to refinance. So how are they going to be able to withstand that headwind?
I think a lot of all that is priced in. As you can see, the recent move that we've had in the small cap index dating back to October of 23. I believe that a lot of that's already been priced in. And looking forward, the market is looking at rate cuts. And I think that's what the sentiment should be. And I think the opportunity of getting ahead of the first rate cut is very important with the small cap index.
Brett, within small caps, though, where are you seeing that investment opportunity?
You know, I think that it's spread out. So, you know, there are some small cap REITs we've taken a look at. You know, it's, if you look at the Bank of America Global Fund Survey, you know, it's the lowest net investment into real estate that we've seen going back to 2009. It's a net 28% negative. We're looking at opportunities in some small cap REITs, actually, because it's baby with the bathwater syndrome. And there are actually some good companies out there that we feel will prevail as rates start coming down.
Well, Brett, I know that you think that we could have a couple of rate cuts this year, but rate cuts aren't necessarily good for stocks. I mean, you had Bostic saying this morning that getting down to, you know, a 0% rate environment would mean that there was a serious issue within our economy. So how do you think about 3 cuts and maintain the view that everything's going to be fine if we get those 3 cuts?
So when we talk about Fed cuts and the different cycles, I like to break it down in a couple different areas. There's a cycle where the Fed goes nice, methodically, and slowly through the rate cut cycle, and there's some that where the Fed cuts really quick. I don't believe we're in the category where they cut quick. The reason why they cut quick is because they've made a mistake. Essentially, they missed it. And usually in that environment, that would be like a 2008, 2009, other historical errors where there's a big crash and they're reacting to it. That is not where in the camp that we believe we're in. We believe we're in a slow cycle, and that is the ideal environment for the stock market.
All right, Brett, we're going to have to leave it there. Thank you so much for joining us. That was Brett Ewing. He is from First Franklin Financial, and he is their chief market strategist there. Now, JP Morgan is kicking off its investor day today. The bank raising its core guidance for net interest income, the key statistic to watch when it comes to bank earnings. They're raising that NII number to $91 billion. That is up from $90 billion. Also teasing additional stock buybacks, saying their excess capital is supporting potential increased buybacks to come, but they do remain cautious. We're getting a lot of interesting information, Shauna, when it comes to JP Morgan on this investor day here. They're talking about AI as well, saying that the company is able to utilize AI to kind of get rid of what they're calling no joy work for some of their younger employees, I would imagine is part of what they're talking about when it comes to that. The CFO also earlier today on that buyback statistic that I mentioned, saying right now we've got quite a bit of excess capital. It's clear that based on the amount of excess that we have, it makes sense for us to increase buybacks relative to their recent pace of about $2 billion a quarter, and they've already started to do that. So buybacks, good news for stocks typically, but we are seeing the stock under pressure this morning.
You know, there's a number of interesting nuggets coming out of this Investor Day so far, even talking about return to office. And I bring this up because JP Morgan, along with many of its peers, the big banks, were the first to demand or to mandate that some of their workers return to the office. They're actually saying return to office, that JP Morgan staffers want to be in the office for the, quote, delightful experience with their colleagues. They don't need to be told to come in, which is a bit different than maybe what we have been reporting and what reports have said over the last several months, as we do still talk about this how leaders are navigating the return to office and mandating who comes in. Obviously, the banks have been at the front of it, but also what you just said about AI, I think is so interesting, with time saving and the revenue growth and allowing the company to get rid of that no joy work is how they put it. And I think when we talk about the disruption that AI is going to have across industries, and this obviously being the financial sector, they're not necessarily eliminating jobs. Obviously, it is going to have some impact and maybe eliminate some positions, but really what it means in terms of productivity, ultimately, what it means in terms of those day-to-day responsibilities. So it sounds like that is starting to take shape right now. It will take years to see the ultimate impact of this because, like we have talked to analysts time and time again, we're very much in the early innings in terms of adoption, but clearly they see this boosting productivity down the line, and ultimately then you can make the argument boosting the bottom line as well.
Yeah, maybe the use of AI is what's making it such a delightful experience for them to come into the office. I'd love to get some fact checking done on that there. Well, Micron shares are in the green today. This comes after Morgan Stanley upgraded the semiconductor company to equal weight. That is up from the previous rating of underweight. They also increased the price target for this name to $130 a share. That is up from 98. The firm citing the upside potential of AI's high bandwidth memory. That is the key kind of area of growth for Micron moving forward. We are also seeing upgrades from some other folks on the street as well, but specific to Morgan Stanley predicting that Micron could announce positive financial results due to the ramp-up phase of what's called that HBM supply. Possibility that HBM supply could become excessive eventually, but for now, it does appear to be a positive influence on the company's outlook amid growing optimism regarding some of the memory market that we have here.
Yeah, and this is a stock, and you can see it on the screen right now. Over the last 6 months, up 65%. In the last month alone, I believe it's up just around 20%. So even Morgan Stanley, Joe Moore calling it out himself, saying that we belatedly are coming around to this drive up that we're seeing in rampant growth here for the narrative surrounding Micron. You can see some of that excitement play out within the stock and the stock's performance here over the last several months. But I think the question going forward when it comes to memory valuation, exactly what that looks like, the discount of EVs to sales, and what they're seeing there, I think obviously goes into this re-rating that we are seeing, the upgrade that we are seeing here for Micron. And then I think this is going to be an active sector, right? When we talk about the results that we have on top on Wednesday, ultimately what this means for so many other smaller players within this space, clearly not a massive rival here to Nvidia up until this point. But again, when we talk about the AI adoption story, when we talk about chip demand right now, at least when it comes to electronics, whether or not the worst is behind us at this point, when it comes to see the street getting a bit more positive on several of these names, we're certainly seeing that lift the broader index as well.
Yep.
All right, well, coming up, Nvidia is the next big earnings report on the street. We will discuss how U.S.-China policy could impact the chip giant next. Nvidia earnings out on Wednesday. Investors are looking to the chip company as the next big test for the market rally. When we talk about Nvidia, lots of focus has been on strained U.S.-China relations. Ultimately, what that means for Nvidia's business. Joining us now, we want to bring in Ronnie Chatterjee. He is a former White House chips coordinator. Ronnie, it's great to talk to you. Thanks so much for making the time to join us here. So I just want to take a step back. When we talk about the chip landscape right now here in the U.S., you were instrumental helping the Biden administration implement the CHIPS Act. What ultimately the disruption, what do you think the chips industry is going to look like here in the U.S., not so much a couple of months from now, but ultimately 5 to 10 years down the road?
Well, thank you for having me. 5 to 10 years from now, you're going to see mega factories producing chips across the United States. And you've seen some announcements over the last 60 days for companies like Intel, TSMC, Micron that was mentioned before, as well as Samsung, who are building all across the United States, Texas, Arizona, upstate New York, Oregon, New Mexico, Ohio. And I think in 5 to 10 years, you'll see the most high-end chips being made in the United States, as well as really important memory and mature node chips and some of the great advanced R&D that we need to bring back as well. So that's my hope in the next 5 to 10 years based on the work we're doing with the CHIPS program.
Well, Ronnie, I want to talk to you about Intel specifically since you bring it up. There's a bit of criticism around the selection of that name. I mean, the stock is down over 30% year to date. They may not have the capital to follow through with the promise of the CHIPS Act funding once that dries up. And they also don't specialize in some of the chips that we had an issue with in the U.S. during the shortage, things like autos, for example. Do you think that the administration is selecting the right firms to be able to follow through on this investment moving forward?
Yeah, and I think the key issue here is firms, plural. You'll see a number of firms have received awards. You know, when governments try to help a particular sector for national security reasons, which is what's happening here with the chip industry, it can be a mistake to just focus on one firm. But that's why you see the big announcements aren't just for Intel and the Ohio and Arizona facilities, but also for TSMC, for Samsung, and for Micron. And as far as those other technologies that are really important in automobiles, medical devices, and the grid, you're seeing big announcements for companies like Polar, Global Foundries, Microchip. So what you see from the CHIPS program is a diversified bet, the way the American taxpayer would want it, rather than just betting on one firm.
You mentioned national security, and I know that some studies of what the impact of the CHIPS Act is going to be is that over half of the jobs created by the CHIPS Act could go unfilled because we just don't have the skilled labor here in the U.S. The administration's messaging has been that the driving thesis of the CHIPS Act is specific to jobs creation. Should the focus be on national security instead, given the headwinds with jobs?
I think national security is the key reason why we want to make the most advanced chips here in the United States, but you can also create really high quality jobs. Take a job like semiconductor technician. You can do a program for a year or 2 years and get a really great job working in semiconductors. You make a great point though. We need to get people more aware of these jobs. We need to set up training programs, and places like Onondaga Community College and Maricopa Community College are among the community colleges doing this around the country. And we'll train that workforce. We've done it in the United States before with so many tech industries. We got to do it again, but it is a big hill to climb, and we got to start working on it as fast as we can.
Ronnie, I'm curious, can you give us some insight just in terms of how the Biden administration, or at least your time when you were in that role, how you evaluate the steps that need to be taken versus the threat, or maybe what we could see in terms of pushback and backlash? How is that evaluated? And I guess how much thought has gone in to the backlash side of things, just in terms of if we do implement more restrictions, ultimately what China's response could be and the impact that that could have on so many of these larger U.S. companies?
The way we looked at it was the legacy of the pandemic showed us that supply chains that were all about just in time sometimes needed to be more resilient for just in case. And you saw so many things during the COVID pandemic that weren't showing up where they were supposed to, and chips were part of that. And so the CHIPS Act was really about building a strong industrial base in the United States for key technologies. When we talk about the export controls, that's on a very narrowly defined set of chips that are mostly going into military hardware. And so as you see in the case of Nvidia that's going to release earnings on Wednesday, it hasn't dented the growth of Nvidia. And in fact, the stock has grown, I think, eightfold since those announcements came about. So I see the export controls narrowly designed around things that go into military hardware, but the chips investments in manufacturing are creating opportunities all around the United States across different kinds of chips, logic and memory. We looked at both of those things, national security and supply chain resilience, and weighed them as we were thinking about designing the CHIPS Act and implementing it.
Ronnie, do you think there's more restrictions that are necessary, or how do you think the Biden administration is evaluating that landscape today?
I think technology is changing so fast. You got to have people inside government with technological expertise who understand markets. And I think you do have that. But they also have to keep an open channel with the government. I mean, you can see this with Nvidia in particular. Every time the new export controls have been announced, they've designed compliant chips to send to other parts of the world. So as long as you have that interaction between the major chip designers, the companies that are manufacturing them, and all across the tech stack with knowledgeable people inside government, I think you can get that balance right. And that's what you're seeing so far.
Lastly, while we have you, Ronnie, there's this idea that looser fiscal policy is happening at the same time as stricter monetary policy, and a potential criticism that something like the CHIPS Act is inherently inflationary. I know that you are also a public policy professor as well, so give us your take. What would you say to your students who might be asking you, is the CHIPS Act inflationary?
We're living during interesting times. I think because the way the CHIPS Act money is being distributed, it won't have the effect that most of the folks are worried about. For example, these big announcements are just preliminary memorandums of terms. The due diligence still needs to be conducted, just like it would on a private sector deal. And that money is not going to start flowing until the end of the year at the earliest. So I think when it comes to the CHIPS Act, look for the investments that occur over the next several years. That's not money that's being pumped into the economy right now because we're still working on the deals. And that's why I'm less worried about that criticism than some folks out there.
Ronnie Chatterjee, it was great to get your insight. Thanks so much for joining us here in Yahoo Finance this morning. Former White House CHIPS coordinator. Thanks, Ronnie.
Thank you for having me.
Well, Apple is making changes to its iPhone pricing in China. Yahoo Finance's Akiko Fujita is following that story for us and more. Akiko.
Good morning to you. Well, that aggressive price cut that we saw from Apple coming through on Apple's official site on Tmall, which is China's largest e-commerce site. The discounts apply largely to iPhone 15 models, with the steepest price cuts on the high-end iPhone Pro Max model. The price of the device is being slashed by as much as $318. That's this week alone. Now, Apple has offered price cuts before, but this is among the most aggressive, and it comes amid heated competition with Huawei. Just last month, the Chinese tech giant released its high-end phone, the Pura 70. The revival of Huawei has really ramped up pressure on Apple in its largest overseas market. Since Huawei's Mate 60 was launched last fall, the company has chipped away at Apple's market share in China. iPhone sales fell 19% in Q1, according to the latest data from Counterpoint Research, with Apple capturing just 15% of the market behind Vivo and Honor. And that led Apple to lose its lead in the global smartphone market, with iPhone sales falling 10% globally, according to IDC estimates. And we keep saying this, but that came at a time when global smartphone shipments increased 8% year on year. Now, there is some important context to provide here when you think about Apple's market share slipping specifically in China, which could have led to these steep price cuts. You look back to 2019, before Huawei was slapped with these very strict export controls coming through from the U.S. Huawei was a dominant player in China. So in many ways, you could argue with the reemergence of Huawei, Huawei's just kind of taking back that market share that it had pre-export controls, now that they've got their own domestic chip operation in place. Apple's slipping, but in many ways, you could argue that Apple's kind of going back to where they were in 2019, where they had that competition on the high end of smartphones coming through from Huawei, right back to where we were before.
All right, Akiko, we got to leave it there. Thank you so much, as always, for bringing us your great reporting. Really appreciate it. Well, turning now to the Middle East, Iranian President Ebrahim Raisi and the country's foreign minister were killed in a helicopter crash, leaving the country without two of its most influential political figures. Joining us now to discuss this, we have Alex Vatenka, senior fellow at the Middle East Institute. Alex, thanks for joining us on this news here. I just want to start on your take on this news. What do you think the next 50 days look like in Iran?
Great to be with you. I think the next 50 days would be more in terms of policies, both domestic and foreign, one of continuity. The fact is that Ebrahim Raisi and his foreign minister, Hossein Amir Abdullahian, essentially didn't decide Iranian policies, both at home and abroad. They were implementers of the wishes of the two main centers of power in Iran. That's the office of the supreme leader and then the generals in the Revolutionary Guards. Obviously, those two centers of power are still very much alive and kicking, and they are still the main decision makers. And for that reason, I expect mostly to see continuity going forward, certainly in the foreseeable future.
Alex, what about the wider power grab within the nation, the ramifications, the influence that this could have beyond Iran and even beyond the Middle East? How are you looking at that and the possibility of that here?
I mean, look, number one is to find out exactly what happened. I mean, this is a helicopter crash, but as you can imagine, there are all sorts of theories out there in terms of whether there was any foul play involved. And if there was any foul play involved, then the question you also want to ask, foreign adversaries were behind it or domestic rivals of Raisi? I don't have any answers in terms of what happened to that helicopter in those mountains of northwestern Iran. But I think one thing is for sure. You have an Iranian supreme leader who's 85 years old. He's been there since 1989. So 35 years, long time to be in power. And he might be around for another few years, decade, I don't know. But the issue here is that the competition to replace him is already very much underway. And this has resulted in intense kind of almost cutthroat competition among the hardliners. And this is the interesting part. This is not a fight between the so-called moderates of yesterday and hardliners. These are hardliners fighting one another for who should replace the supreme leader when the day comes that he's gone.
Well, what's interesting, too, is that the Iranian people had moved to not exist in a monarchy. And now there's this question about whether or not the voting process is going to involve much of a choice for the Iranian people. What do you make of that change?
To be honest, you don't have to be cynical to believe what I'm about to tell you. Iranian elections haven't mattered since day one, going back to 1979. These are always highly regulated, engineered elections. This is a process where only candidates that have been essentially approved by the supreme leader can run for the presidency, for the parliament, and so forth. So it's, in many ways, it's a nice show that the regime puts on, but the wishes of the Iranian people have never really been reflected in who represents them in public office since 1979.
Given this leadership transition, what does it look like for Iran's ability to navigate what is an extremely complex situation right now within the Middle East?
You know, again, I go back to a point I made earlier, is one of continuity. Raisi wasn't somebody who really stood for anything in terms of big foreign policy vision. Certainly what Iran is doing in the region, if you take the issue of Iranian policies towards Israel, what Iran is doing in places like Lebanon, Iraq, Syria, Yemen, none of those policies are policies that Raisi came up with or implemented. He inherited them as president in 2021, and he never said no to his superiors, essentially the office of the supreme leader and the Revolutionary Guards. He never pushed back. In fact, he agreed and did what he was asked to do. He was not someone who had a political vision or a base of his own. He was very much someone who came to power back in 1980 as a 20-year-old and spent the next 45 years of his life doing what he was asked to do. And that's why he survived until obviously the helicopter crash.
If Iran is internally focused over the course of the next 50 days dealing with this, what opportunity does that give to Iran's adversaries?
I mean, look, again, I would just be careful in not putting too much emphasis on the role, the centrality of Ibrahim Raisi, because when you hear the title president, you assume automatically, based on Western standards, that means a lot of power. In fact, the one issue he had most power over was economic policy. So he had to find ways to go around the sanctions that the U.S. has imposed on him, on Iran, certainly since the maximum pressure campaign of President Trump starting 2018. And he failed miserably at that. I mean, Iran is today a single customer economy, essentially. China buys Iranian oil, and that keeps the Iranian economy somewhat alive, but it's shrinking daily. Raisi came in after Hassan Rouhani. He was supposed to fix things. He couldn't. These are some serious structural problems that need to be, essentially addressed. He doesn't have the political vision or the power, and therefore, at home he failed. And as I said earlier, in terms of the region, he just implemented what he was asked to do. If you compare him to someone like Hassan Rouhani, the predecessor, at least Rouhani pretended he could have his own vision. He would push back on the supreme leader and say, maybe we should find some compromises with the United States and so forth. Raisi never did that even, because he knew he was in a position to stand up to the supreme leader who had given him the job on a silver platter.
Alex, really quickly, in our final question here, given what you're saying about the role of the president previously, what is the single biggest potential impact of this?
I think the one thing I will be watching out for as an Iran watcher is if this was foul play or if Raisi's departure suddenly results in intense competition for power among the hardliners, and that they get to a point where they can't control the infighting anymore. We know that infighting is going on behind the scenes, but if it spills out into the public domain, that would take us to a whole new stage in the evolution of this Iranian regime.
Alex Vatenko, we really appreciate you taking the time to join us here this morning, Senior Fellow at the Middle East Institute. Thanks, Alex.
Thank you.
Well, coming up, Kontoor Brands CEO talking about the state of the consumer and the spending trends that they are seeing at this point in the economic cycle. They'll join us next. We'll be right back.
We're getting a pulse on the consumer here, kicking off a big week of retail earnings from the likes of Macy's, Target, Elf, Deckers Outdoor, and Ross stores. We're going to get clues about consumer spending as inflation still remaining sticky, particularly in apparel, where the rate of price increases in April remains above 1% from the prior month and year. Here with more live from the New York Stock Exchange, we have Scott Baxter, CEO of Kontoor Brands. Kontoor rang the opening bell this morning to herald in its 5-year anniversary, and we also have Yahoo Finance's executive editor Brian Sozzi joining us at the desk. Take it away, Brian.
Scott, good to see you here this morning. I can't believe it's been 5 years since the company broke up from VF Corp. And just in terms of demand, in a moment where consumers are so focused on inflation, what are you seeing on the top line?
Well, we're seeing, you probably saw our last quarter, we had some inventory challenges with our biggest customers, but we hit the numbers and actually exceeded what we had committed to. And we've kind of said that program that we're on right now is going to be complete through the rest of the year. So, what we've committed to, we said we're going to hit through the remainder of the year. And I think our feeling on the consumer right now, Brian, is pretty simple, that the consumer right now is going to go ahead and buy the things that they need. So to be in a space like us where we're a consumer staple and you use our product for work and recreation, it's an important space to be in. And also, we're at a great price point. That's really relevant right now in this marketplace.
Scott, are you still out there pushing through higher prices just because you see various pressures in the supply chain?
No, we're not out there doing that in any significant way. We think that we're in a really, really good position. We like how we position our brands and where we position them in the specific channels that we're in. And our consumers gotten used to our brands at the right price point in the right channels. So we think we're in a really good position, and we've been gaining share, Brian. So that's been really important to us. During a tough time gaining share, those are some of the things that you want to make sure are getting done in your brands.
Scott, I'm curious, what do you attribute that to? And then the ability here to maintain that brand, that larger market share that you now have because of the result of your more competitive pricing. How do you keep those consumers coming back once inflation isn't as big of an issue anymore?
I think for us, it's been the demand creation. We build great products, so we're designing a product that people actually want to buy. They want to buy it at full price, and then we back it up with some incredible demand creation. I mean, just this past week alone is a great example. Lainey Wilson is a spokesperson for our Western line, for our female Western line, and here she wins, Entertainer of the Year at the American Academy of Country Music Awards, Female Vocalist of the Year, and we've got a big line coming out with her in the fall that she helped design. So the timing of all that and just, the explosion of her popularity in our line together, it's just really perfect timing. So it's things like that from a demand creation standpoint that keep us relevant in the forefront with our consumer.
Well, Scott, if you're going to bring up country music and jeans, I got to bring up the new queen in the space, which is Beyonce. Are you concerned at all about a song like Levi's Jeans coming out and the popularity of that?
No, because we just had a song about Wrangler jeans come out from a Miranda Lambert, so we just had one happen. So
Miranda's, no, Beyonce,
I don't know.
Scott, come on. I mean, you got to be a little bit concerned, right? The market opportunity of a song like that is huge.
No, not for us. We're so embedded in the country music, space. We've been the premier country music jean in the Western jean since 1947. So we're in a really good spot with our consumers from a country music and also a Western standpoint.
Scott, a week ago, Under Armour, I think, caused a lot of folks to raise their eyebrows. Really nasty warning from that company. They're dealing with their own issues, and I get it, but they did call out continued pressure in the wholesale channel, which really, I think, reminded me and a lot of investors that department stores, they're still closing doors. And I know a lot of brands are going direct to consumer. They want to sell stuff online, but these closing of these stores, what happens over the next decade as you lose places to sell jeans?
Brian, that's really interesting, and don't know if you know this, but we really don't have a big department store business at all. That has not been our strength and not where we've concentrated. Our business, is mostly with, Walmart and Boot Barn and Target and places like that. So from a pure department store standpoint, it hasn't been a strength of ours. So it hasn't impacted us in that respect. But we think the consumer is going to our biggest and core customers that we talk about. That's where they're shopping. And they continue to do well, continue to get stronger, and they're running really good businesses. So it's a really strong partnership for us.
What I always enjoyed, Scott, following businesses like yours is orders are always placed months in advance. Talk to us about any signs of what you're seeing for back to school demand. Of course, a lot of consumers are going to be going back to school, buying jeans for their kids ahead of an election not too far removed, lots of uncertainty on the economy. Any indications you're seeing that this might be a good back to school shopping season?
Yeah, I think it's going to be fine, but I will tell you, Brian, in the last decade, back to school shopping has changed. Most families now just buy and purchase product throughout the year when it's needed and when it needs to be replaced. The going into the stores, in July and August and bulking up on a lot of product for the upcoming school year just doesn't happen at the capacity that it used to. So for us, we run a business that, as you've seen quarter by quarter, is pretty steady quarter by quarter. Our business is extremely predictable.
All right, Scott Baxter, great to have you here in Yahoo Finance, CEO of Contour Brands. Thanks so much for joining us here from the New York Stock Exchange. And of course, our thanks to our executive editor, Brian Sazzi, as well. Thanks, guys.
Thank you.
Well, story that we're watching this morning, Red Lobster filing for Chapter 11 bankruptcy, citing higher labor costs, rising rents. Now, lenders had infused $20 million worth of loans in February, but were unwilling to contribute more without support from the owners. This is according to the latest court filings. When you take a look at this business here and some of the struggles that we have seen play out within Red Lobster. So they're working through this process to shrink their footprint. They're trying to find a buyer. The seafood chain's CEO here blaming, quote, difficult macroeconomic environment, a bloated and underperforming restaurant footprint, failed or ill-advised strategic initiatives, and also increased competition. We know that they have had a couple of promotional events that haven't necessarily resulted in a boost to their business here. So certainly a tough time right now for the industry at large, and Red Lobster here filing for Chapter 11 bankruptcy given the mounting challenges that we just listed.
Yeah, and there's a concern that this potentially is coming from the unlimited shrimp deal. This is the big talking point here, right? Which I know it sounds funny, but it originally cost $20. Then they went to a lower fee. In May 2023, they changed the $20 unlimited endless shrimp from a limited time offer to a permanent fixture, rather. That cost the company $11 million. That is not insignificant here, given the amount of debt that they already had on pace. In the last 12 months, the company lost $76 million, so $11 million, a pretty decent chunk of that overall picture there. The company overall saying that the assets and liabilities could be from $1 billion to $10 billion each in its bankruptcy petition filing here. So a big question mark for the company moving forward is what they're going to be able to do, because they are able to maintain operation while they figure out how to repay their creditors after the bankruptcy filing. So what they're going to be able to do to get some of the capital needed to repay their creditors still remaining a big question, but the unlimited shrimp is clearly not a successful strategy there.
It was not a successful strategy. Remember, Darden Restaurants sold Red Lobster back in 2014. They sold it to the PE firm Golden Gate Capital. That was for just around $2.1 billion. And Golden Gate parted with its remaining stake in the chain back in 2020. They sold that to Thai Union Group. So again, the future here very uncertain when it comes to Red Lobster and how this is all going to play out. Maddie.
Absolutely, Shauna. Well, coming up next, how is inflation affecting American summer travel plans? We're going to have Priceline CEO right here on Yahoo Finance to discuss. Stay tuned. As summer rolls around here, a new survey shows that over 86% of Americans plan on traveling this season, but we've got inflationary prices persisting. So will we see a shift in how people travel, whether that's vacationing closer by, opting for all-inclusives, or just taking shorter vacations overall? For more, we're going to bring in Brett Keller. He is Priceline's CEO. Brett, thanks so much for being here with us. Look, I want to jump in on the inflationary picture here, because that is, of course, what we are fascinated with here at Yahoo Finance. What are you seeing that indicates to you where the consumer is heading with regards to inflation?
Well, so far, global leisure travel demand has held up very well. In fact, it's booming in Asia. Europe's sitting nicely in the U.S., while trailing the other two countries is still holding up. In fact, as we look forward to Memorial Day travel, we're expecting close to a record number of travelers hitting the roads and probably record numbers of travelers moving through the airports. So far, consumer demand is holding up, and I think that's largely in part to airline ticket prices actually being down year over year by as much as 15%. And that's really helping, I think, to spur more airline traffic. The airlines have opened up more capacity as a result.
Brett, are travelers, though, are they looking for more deals just in terms of the activity that you're seeing on your side? And maybe ultimately, are they waiting to book until a little bit later in the hopes that maybe some of those prices will drop?
Well, shopping patterns are higher. So we are seeing more people shop ahead of their actual booking to make their reservations. But we aren't seeing people wait until the last minute to make these reservations. People are booking ahead. In fact, the booking window is pushing out a little bit, which means people are a little more comfortable with making the reservations ahead of time and planning their trips a little more carefully. So a lot of shopping behavior, but still planning things out. Hotel prices aren't quite falling to the degree that airline ticket prices are falling. So a little more pressure on the hotel side.
Well, that's interesting. Talk to me about the pressure that you're seeing on the hotel side and to what extent you feel like that is potentially correlated with some of what we're seeing from Airbnb in terms of users just sort of starting to be a little bit over the hidden fees and the booking experience that's offered through that platform.
Sure. Well, 2023 was a very big travel year. It was the first full year of no constraints, and people had a lot of excess funds. And so they really traveled hard and used a number of different booking methods to get deals on travel. As we move into this year, we're moving more here in the U.S. into a more typical standard pattern of travel with peaks in Memorial Day and midsummer, and then with some nice travel windows in between where you can really find some better deals for the consumer. And so I think what's happened is really people are falling into a more normal state of travel and doing a little more work to really find what fits their budget for them. And, listen, in the hotel industry, capacity continues to be added at a very slow and steady pace, about 1% a quarter here. And so there's not a lot of new opportunity for hotels. So hotels have been able to keep their prices higher, whereas the airlines have been adding capacity at a pretty heavy rate. United just announced in their first quarter results that they added 9% more capacity. That's a lot of capacity moving into the airline space.
But when it comes to the fact that rates are still high, inflationary pressures or inflation is still very sticky, if we don't see any sort of rate cut, if we don't see any more future improvement on the inflation front between now and year end, will we then see more of a deterioration? Or I guess, how are you looking at that aspect, that possibility?
Well, it's obviously hard to predict what's going to happen with consumer travel. Listen, travel has historically been a highly prioritized part of the consumer's budget. And so we continue to see that now, even though where some commodities and other hard goods, people have pulled back there. Travel still seems to be healthy and moving forward. I think what will happen is you'll see suppliers start to really pull their prices back, which will open up more travel opportunities, more deals for consumers. So they'll be spending less to take the same kinds of trips. And I think we're seeing a little bit of that today in the U.S. in some of the shoulder periods where some of the larger hotel chains have had to discount their prices a little bit in order to spur demand, but the demand is still there. And especially in the peak periods, we're seeing very robust demand.
Well, I want to switch gears a little bit. I know that you have your own AI-powered travel assistant, Penny, but I am curious about some competition for Penny because, I'm already on ChatGPT throughout most of my workday here. Is that a potential headwind for you that folks are already on platform for something like ChatGPT and can just ask that platform to find them a cheap travel deal and then book flights directly through airlines versus coming to you?
Well, listen, ChatGPT is a great place to go if you've got general questions about travel. If you're looking for something very specific, though, to what you're looking at, what you're booking, really, as you move through the transaction experience here at Priceline, you can get very direct answers that you're not going to find as you move out of our flow. We'll be able to tell you what availability looks like and what pricing looks like real time for a given hotel or flight, whereas the other bots and engines outside of the travel ecosystem don't have access to that information. In fact, we have a lot of proprietary prices and inventory that can only be accessed by our unique travel bot Penny.
All right, Brett Keller, CEO of Priceline, thanks so much for taking the time to join us here this morning. We appreciate it.
You bet. Thank you.
All right, we want to stick with travel. Shares of Norwegian Cruise Lines, they're jumping after the company lifted its guidance for the second time this month, continuing to see record bookings. We've been talking about this pent-up demand, the fact that consumers are still willing to spend on some of their trips. Norwegian, they're benefiting from that boost that we're seeing within its guidance. You're looking at gains of just about 7%. Now, it is the second profit boost, like we were just talking about, in a month here. They boosted their EPS outlook. They now see $1.42. The 2026 plan now includes improved margins and lower net leverage. So the demand is still there today. Maddie, I think the question, though, was what that demand is going to look like, kind of what we were just talking to the CEO of Priceline about there minutes ago. Just if we do see any sort of waning demand because of very sticky inflation, because of the fact that consumers are still under pressure later on this year into 2025, how quickly maybe that could potentially erode or really weigh on some of these larger travel names.
Yeah, it's a really good point, especially because, and we've talked about this before, Sean, and you've pointed out that the amount of growth that we've already seen from some of these cruise lines does put them in a position where it's a little bit hard to maintain that growth. But interestingly, they do note that by 2026, they expect EPS to hit $2.45. So there is a little bit of longevity, at least in terms of what they're seeing here. But you mentioned the full year adjusted EPS that they're anticipating currently about $1.42. Up from the $1.32 rather situation that they're in currently, and again rising on those boosted year targets. Also, we're seeing peers in the space gaining as well, so that could be an indication that the street is seeing that we're going to have kind of gains across the board when it comes to some of these cruise lines. Viking Holdings, Royal Caribbean, and Carnival seeing some green across your screen when it comes to the travel space. So potentially a bet that consumers are going to continue traveling, not just overall, but on cruises, which fascinates me because I would never go on a cruise ever. But
yeah. Never say never.
Personal.
Right? You never know.
Personal choice.
No, but I think it has been remarkable, right? This unprecedented surge that we have seen within the cruise industry, because it wasn't too long ago, 4 years ago, when people, unfortunately, because of COVID, people have begun to sick on ships. There was people that were stranded in XYZ locations, and there was this very much this sentiment. We would talk to former passengers, we would talk to some of the executives within the cruise industry, and there was certainly some fear, some trepidation, just in terms of what that recovery was going to look like, how quickly people would be willing to go back on cruises. And then not only are you trying to get back to what your customer base was before, but as always, you're trying to expand that customer base and the realistic ability for them to do that. When you take a look at these results, and it goes beyond Norwegian, like you were just saying, Royal Caribbean, Carnival also reporting record booking levels. It really is amazing and astonishing how quickly the industry has been able to recover and then further seize some of that growth here in the years ahead, as is reflected here from this outlook update that we're getting from Norwegian.
Absolutely.
So certainly we'll see. But again, a group of names to keep your eye on today in today's trading day.
Absolutely, Shauna. We're going to do a final check of the markets. We're 90 minutes into the trading day here. Looking at gains across the screen here. The Dow holding on to that 40,000 level, above that actually, after closing above that 40,000 level on Friday. The S&P is up 0.3%. The tech-heavy Nasdaq up 0.6% as we prep for those Nvidia earnings coming up on Wednesday here. Well, that's all from us. Coming up, we have Wealth, dedicated to all of your personal finance needs. Our own Brad Smith is going to have you for the next hour, so stay tuned.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action,
with step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. And on today's show, guess what? A new Gallup poll says inflation is Americans' biggest financial problem. We're bringing you an expert with tips on how to combat inflation at every age. And Nvidia has been dubbed a de facto AI standard by Goldman Sachs and is set to report quarterly results this week. We'll dive into the lofty expectations and smart positioning strategies going into the event. Plus, Memorial Day weekend is upcoming, and retailers, they're anticipating that the long weekend may include some shopping plans. We've got your rule of thumb for how you can ball on a budget and spend smart in a sea of sales, and what you can hold off on the other side of that. But first, let's take a look at some of the market action here. We're 90 minutes into today's trading activity, and we're taking a look at the Dow Jones Industrial Average right now, holding on to gains of about 0.1%. S&P 500, you're seeing that up by about 0.4%, and the Nasdaq Composite, you're seeing that higher by 0.6%. Well, the Dow holding around 40,000 after closing at the landmark level for the first time ever on Friday. And that has Wall Street feeling pretty giddy. But Main Street isn't necessarily feeling all the love. Consumer sentiment is at a 6-month low, with Americans citing inflation, high interest rates, and concerns over unemployment. This is backed by a recent Gallup poll where 41% of Americans name inflation, or the high cost of living, as the most important financial problem facing their family. And in the corporate earnings world, 219 S&P 500 companies mentioned the term inflation on Q1 earnings calls. That is still staying above the 10-year average, but quarter over quarter at least showing some easing. So what is this discrepancy between stocks at all-time highs and consumers feeling down on the economy? Joining me now, we've got Eric Friedman, who is the U.S. Bank Asset Management Group Chief Investment Officer. We've also got Stephen Rasciuto, who is the Mizuho Securities U.S. Chief Economist of Fixed Income. Great to have both of you here with us today. Let's start first on the economic side of this. And Steve, particularly as we think about where there is this disconnect between what Wall Street's saying and what Main Street, or what the household economics are feeling right now. What's jumping out to you the most, at least in the sentiment readings that we're seeing?
Well, I think the difference really is the price level is the problem for households, not necessarily the inflation rate. It's the level of prices. Prices went up substantially in the post-COVID environment, and they continue to be at a high inflated level. And that has really eaten into household disposable income in terms of their discretionary spending. Now, on the other side of this equation, the inflation is helping corporate America produce solid earnings, and as a result, it's driving the equity market. So the tale of two, I don't think really is necessarily the tale of two. It's the same thesis going throughout in here, that prices are high, inflation is helping to keep those prices remaining high, and that's really driving the ability of companies to have pricing power, and that's driving earnings, and that's what's driving the equity markets.
And so, Eric, how much is that showing up in earnings, as Steve was just mentioning?
Yeah, it's showing up quite a bit. If you look at the overall levels of corporate earnings growth expected for this year at about 8.5%, and then next year expected at 10.5%, those are some pretty large numbers. And certainly part of that is just inflation. If you look at what we're seeing in nominal terms or not inflation adjusted, you're getting that higher for longer type of mentality really seeking into and seeping into corporate earnings. So I think the other thing that's really important is not only is it impacting corporate earnings, but also the housing market. And one of the things that you're seeing is that if you own a house, your house value has probably gone up. You're spending more money. If you don't own a house, you want one. It's, of course, very difficult to get one, both with respect to housing prices, but then also the cost of financing. So that has a double-edged sword effect, if you will. If you have a house, you feel pretty good about it. If you don't, you're really in a tough spot because of just how unaffordable housing has been and likely will be for some time.
And just to follow up on that as well, I mean, that is one of the areas that the Fed and data continues to point out, is that when you have homeowners equivalent rent, or when you have the cost of shelter and the cost of energy continuing to be the stickiest parts of inflation, there is a consideration for where that also impacts other areas of household spending too. And Eric, just to follow up on that, has that shown up in, especially as we're looking for some of these retail earnings over the course of this week, where CEOs are talking about pullbacks in certain aisles because there are elevated expenses that households have to consider right now.
Yeah, Brett, we are seeing that. And if you look at some of the overall, let's call it demographic differences, you've got middle income and upper income consumers doing pretty well. Lower end consumers are actually, I should say, lower income consumers, those that are really having a tough time with borrowing costs, this elevated, also oil prices, which remain quite sticky. That's a larger part of their consumption basket. So that has been an environment that has been relatively persistent. Starting to see that really pick up, though. And if you look at some of the earnings we had last week, as well as from retailers this week, those are really important tells for us to understand just sort of what sort of dichotomy we're seeing across the consumer landscape. So in general, consumers are doing well, but you're starting to see some level of disparities across the different income cohorts, which again, corporate earnings can provide some more insights into.
Steve, just one more question on the economy here, and then I want to shift to some investing strategy. But specifically, as we think about what will force the Fed to cut, what is it that's going to show up in the data that will finally perhaps be the determining factor outside of us getting to that 2% target that seems ever elusive, at least as of right now?
Well, let me be clear. We don't have any rate cuts priced into our forecast for 2024. And the reason for it is we don't think the economy is going to give them the opportunity. What could give them the opportunity would be a deterioration in the labor market. And it would have to be a bit more of a sustained deterioration in the labor market, given the fact that inflation has gotten stuck. So I think the reality is there's likely to be less, if not no, rate cuts this year. And that is the one thing that I think is missing from the valuations in the equity market as we continue to grind higher here is, yes, earnings are very, very good, but the market also is assuming that you're going to get rate cuts this year, and that may continue to get pushed further out in the calendar. Now, does that suggest a correction in the equity market? Probably not. But I think you have to think about 2024 more as a year in which the economy catches up to the equity market rather than the equity market, retraces back to the economy.
Eric, as we're thinking about the equity market here, Dow crossing 40K, significant milestone for investors that are trying to figure out, okay, what next? They're charting their own strategy, even from a high like this. What is that next natural consideration as investors have to realize or think about the trends that have driven us to this point and whether that's still locked in so much so that they can remain comfortable in what are becoming some very overcrowded trades?
Yeah, I think that really is an important focal point in terms of the notion of overcrowding. Look, Steve and his team do outstanding work, and we have similar conclusions about just the importance of interest rates when we're looking at things like discounted cash flow models, the way that we try to look at stocks or bonds or other instruments. And so the key consideration is where will we actually see interest rates settle out over time. And there's been a little more of a reconciliation between the Fed and the market in 2024, but 2025 and 2026, there's a bit of a disparity there. And one of the reasons why we think there's a disparity is because we think that the market expects commodity inflation to actually hang around and potentially even inflate from here. So one of the things that we're doing in portfolios is actually hedging with physical commodities. We think that's a good thing to own in a client's portfolio. You generally don't have that same type of exposure in corporate earnings. And so owning more index-based commodity exposure, we think makes some sense. The other thing that we're doing is really diversifying sources of cash flow. For people who just own stocks and bonds, we think there's lots more that you can do in a client's portfolio. And so owning things like reinsurance, owning things like non-agency mortgages, those are, we think, some unique and interesting sources of cash flow because, again, this notion of rate cuts or no rate cuts, but also probably more importantly, where will the Fed settle out over time? Will we get back to that lower federal funds rate that we enjoyed post the 08-09 crisis? We don't think so. We think it's going to probably normalize somewhere with a 3 in front of it as opposed to the 5 in front of it right now. So I think there will probably be some level of rate cuts, but not as many as the market may anticipate for this year and perhaps the balance of next year.
And so with that in mind, for a normalization portfolio strategy, are there areas of the market that investors can feel comfortable with a set it and forget it strategy, and which sectors would that be in, Eric?
Yeah, probably never a set it and forget it, just because it is this is one of those environments where things move around quite a bit. But I'll tell you some of the areas that we're pretty focused on. Number one would be the energy market. Again, we talked about commodities a second ago, but energy companies have been very disciplined. They've been forced to be so through shareholder activism. So that's a spot that we think there's still an opportunity to unlock some value. We still like technology, although we do think that there's, again, a big stand and deliver time this week. If you look at what you're seeing in AI, the notion of more, let's call it OEMs or producers actually delivering services across the landscape will be important to justify evaluations. I also think there's an area that is probably a little less appreciated is equal weighted S&P. You talked about the Dow reaching its all-time high. Equal weighted S&P has lagged for the last couple of years, and for good reason, because of course we've had more of a tech-driven backdrop. So we think that for those clients that are looking for a little more safety and also want to participate in large cap companies, because we actually think there's some refinancing risk in small cap, owning equal weighted S&P is probably our preferred method of getting large cap equity exposure right now. Those would be the things that we're more interested in this environment, Brad.
Just lastly, while we've got you guys, Steve, we heard Yardeni Research essentially say today the Q1 2024 season is over. Earnings season is over, they said. And, kind of looking at the S&P 500 EPS as the basis there versus the actual results that it came in and exceeding expectations. All of those things considered from a macroeconomic perspective, as we look out to the rest of the earnings seasons that are set to come over the course of this year, what is one major theme that investors should be prepared for coming up from the purview of many C-suites?
Yeah, I think as long as the Fed is telling you they want to cut rates, even though they're not necessarily ready to pull the trigger, the buy on dip strategy really just continues to dominate in the marketplace. And I think that's going to create an opportunity for people to originate not only debt, but also a new equity origination going forward in here. The spreads are very, very tight. Yields are about 20 to 30 basis points lower than we were at our recent peak. And I think you're going to get people looking to come in and tap the market as a result of that.
My thanks here to U.S. Bank Asset Management Group CIO Eric Friedman and Mizuho Securities U.S. Chief Economist of Fixed Income Stephen Rasciuto. Gentlemen, thanks so much for taking the time here this morning.
Great to be here. Take care.
Thank you. You too. Coming up, everyone, big bets on the AI trade, with Nvidia set to report quarterly results in the days ahead. How can you set yourself up for success in the AI space? That's next.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market value is well over $1 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5th, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its NVIDIA Drive chip for powering driver assistance technologies. In 2016, NVIDIA kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted NVIDIA RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using NVIDIA's Tesla P4 graphics cards for its Google Cloud platform. In 2022, NVIDIA debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. And in May 2023, NVIDIA eclipsed the $1 trillion market cap mark, joining the ranks of mega companies like Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading at over $700 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, NVIDIA remains at the top of the tech industry.
Price to earnings ratio, or PE ratio, refers to a company's share price relative to its earnings per share, or EPS. PE ratio helps assess value to a company's stock. So let's break down all of these terms. A company's share price is the amount of money that it takes to buy one share in a company. Earnings per share, or EPS, refers to how much net income a company makes divided by the number of outstanding shares. And so the equation for PE ratio is the share price divided by the earnings per share. And there you're taking a look at the ratio formula. Now there's two common measures of PE, and that's both forward PE and trailing PE. Trailing price to earnings, that relies on past performance and uses the total EPS for the prior year. So current share price divided by the EPS for the prior 12 months. But forward price to earnings ratio, which we'll dive into now, that gives future earnings and uses future earnings guidance rather than those trailing numbers. So this is seen as more of a forward-looking indicator. Now, overall here, PE ratio, it can be used to gauge the value of a company, and you compare that ratio to itself, a PE ratio from a prior year. It can be compared to other stocks in the same industry or against the broader market like the S&P 500 as well. Well, another test to the market's momentum this week is Nvidia. The AI darling is announcing its first quarter earnings results after the bell on Wednesday, capping off reports from America's biggest tech giants. Nvidia shares have been performing well, up 90% this year, and its earnings report will certainly impact the AI trade. So, how can you set yourself up for success ahead of these big results? For more, I'm joined by David Wagner, who is the Actis Capital Advisors Portfolio Manager. David, great to see you. Thanks so much for hopping on. Absolutely. Let's dive into this one here. Nvidia, the bellwether for the AI trade. What is the anticipation here, and is this, for what we're considering and expecting to be another Goldilocks type of report they're going to need to deliver, are they going to be able to hit on all the metrics that Wall Street is looking for?
Yeah, Brad, obviously you're right. NVIDIA is the linchpin for the AI market narrative that we've witnessed for basically the last 12 to 16 months. But really looking at this report, I'd actually probably flash back to the report just 3 months ago. I think that there was a lot of optimism and exuberance really heading into the NVIDIA report just 3 months ago. But it really became a no style type of event. That's kind of what I'm expecting out of this quarter right now. I mean, we've been so accustomed with NVIDIA having some type of beat and raise and an unbelievable revenue beat on the top line mechanism. It's just become standard. But that's also why that this is one of the most crowded names out there in the market right now. So I think that the market's pricing in about an 8 to 9% move on the upside or the downside if you look at vol levels. I would probably be selling some short calls on this because I just don't think that a lot of the exuberance heading into this report is actually going to be shown in the stock price. I think it's just going to be a 3-wood right down the middle of the fairway. It's going to be a beat and raise, but I think the commentary that we're going to see from Jensen itself, especially on the transition from the Hopper to Blackwell, is really what's going to be the investor focus on Wednesday night.
All right, I can tell you we're watching the PGA Championship over the weekend for sure, David. So that's a good thing, good one for Xander.
Thanks for noticing.
Ultimately, you know, one of the huge things that investors have to consider is where NVIDIA sits in terms of its value for any investors that are considering kicking the tires on buying in versus some of the rest of the AI annex names within the market right now. What's your evaluation there?
Yeah, Brad, obviously that's the big question right now. And it really reminds me of Bill Gates' observation that the impact of technology is often overestimated in the first 2 years, but then underestimated over the next 10 years. But with that said, yeah, NVIDIA is absolutely going to incur some type of demand-driven air pocket over the next few years. But that really doesn't mean that the stock's overvalued in my mind. You know, I think we need, as investors, need to be focusing on the denominator, the earnings aspect of the PE multiple you're just talking about, and not the numerator with the price. Now, this call on valuation was much easier heading into this year when NVIDIA was trading at 30 times forward earnings, which was about 15 turns below its largest peer, AMD. But not only that, it was trading very much in line with Intel, which is a company that, in my mind, continues to let investors down via no technological advancements over the past few years. But if you fast forward to today, like NVIDIA does trade at a premium to Intel. It still trades at a discount to AMD. So that makes me believe that this stock right now, trading at 37 times forward earnings, it's going to be a little bit more fairly valued. But like I said, I should state that investors should not focus on the valuation for NVIDIA right now. They need to focus on the revenue growth and the continued demand for their products and the transition from Hopper to Blackwell that should occur later this year. That should be the focus here. If the stock were to materially drop, I think it's going to be due more to an earnings air pocket or an earnings whiff than just simply valuation.
We were just taking a look at the year-to-date chart for Nvidia. Of course, a landmark run for itself over the course of the past 52 weeks and during 2023. And then here, year-to-date, adding on another 90% in gains here. When we think about more broadly for where within the AI trade is still has the most upside potential, whether that is the chips, whether that is the language learning models that are going to be set to come forward, whether that's just the utility companies that are set to make bank because of all the different data centers that they're going to have to operate as well. Where is the most compelling part of this?
Yeah, I agree with you that it's going to be more on the picks and shovels aspect of the trade itself. So that still will be in, the intangible aspect of the chips themselves. But again, on the utilities, I think the utilities is somewhat a misnomer because it's really caught my eye here lately because, utilities and rates, they should have an inverse correlation. Yet utilities have really caught a bid in the face of higher rates. But utilities, they're very much a regulated sector within the S&P 500. But I think there's other ways to play proper utilities that are not as regulated, more on the private side, like Quanta Services, PWR. Basically, they're a private company that deal with the transmission lines of going from the utility location itself to the data centers. That's not regulated by the government. They have basically a backlog that goes out 10 years from now, and they have a lot of pricing power. It's a great company. Valuation may seem stretched if you look at it, versus 5-year history, but I think it's very much warranted for the amount of work that's going to be really coming due, not just in a year or two from now, but 10 years down the road, because these are projects that just can't be planned 1 year out. They're planned 4, 5, 6 years out. So there's a lot of visibility into the backlog of this company. And I think that's another great way to play this AI narrative outside of, your AMD, your Nvidia. But I'd also look at like a stock like Vertiv.
We were talking on Morning Brief about the number of companies that were mentioning AI on earnings calls in this most recent quarter and even going back to Q4 of last year and the stock price increases that they've seen thereafter. But what is the warning sign that investors should be looking for if there's too much exuberance from some of the companies that doesn't seem like it has anything to do with AI?
Yeah, I guess there's that phrase pay to play, but when it comes to a lot of these earnings calls, it's say to play. They want to say AI and they think that they can play in that narrative itself. But, you have to look through the forest through the trees here to see who are the actual beneficiaries. But coming out of earnings season, Q1 2024 earnings season, Brad, I think my biggest takeaway was actually the amount of spending that is going to be incurred by the Magnificent Seven names moving forward. I mean, obviously, the absolute number was supposed to be very high, but I think a lot of people are really taken back by the actually CapEx revisions from this past quarter. I think the Magnificent Seven are expected to spend $328 billion just in 2024 on CapEx spend, and that's basically through AI. So my big takeaway here is, I think over the last year, the market has focused on the Magnificent Seven and their profitability. I mean, just look at Meta itself and its year of efficiency. But the market's going to have to really start to focus and recognize how it's going to warrant the valuation of these Magnificent Seven names as we transition from, the years of profitability and focus on ROIC to the transition to this really heavy CapEx spend that's really coming out of these seven names, and see if that can actually transition from CapEx spend into incremental revenue growth and economies of scale for the profitability, like through return on invested capital.
Yeah, some supreme spending that they're putting forward. We'll see if it could actually generate some magnificent returns here going forward as well. David Wagner, always a pleasure to speak with you and get some insights. Aptus Capital Advisors Portfolio Management. Good to see you.
Great seeing you, Brad.
Absolutely. Coming up, we explore how to protect your wallet from inflation at every stage of life. And will Social Security be there for you when you're ready to retire? Maybe, maybe not. We'll see how advisors are preparing their clients for a world with uncertain Social Security benefits. That's right after this break ahead. Stay tuned. Inflation moderating slightly last month, but that doesn't mean your wallet isn't still hurting from some rising costs. The inflation rate remains above the Fed's 2% target. So, how can you combat inflation at every stage of life? To break it all down for us, we've got Kelly Smith, Edelman Financial Engines Financial Planning Director, here with us. Hey, Kelly, good to see you. So, people across different age portions of the economy right now trying to understand, okay, what is the best financial positioning that I can employ to help me outlast high costs, especially if it's some of the stickier services side on housing and energy that we've seen? What are some of the effective strategies that you've seen?
Yeah, good morning. It's really important to understand that the best way to combat inflation is to get out in front of it. I understand that we're in a position now in the economy where not everybody has had that luxury of doing the planning, but it's really important when you are preparing for inflationary environments that you are saving. It's so important to build that emergency savings. Depending on where you are in your up toward retirement, you want to make sure that you've done retirement planning, retirement savings, maximizing those and minimizing debt where possible.
And so with that in mind, I mean, we're taking a look at some of the top tips here and building a cash reserve. What is that new figure, or a good percentage basis even, to keep in mind when starting to build up that cash reserve?
It's a little bit different for everybody. When I'm working with my clients, it really just depends on their personal situation. A single income household is going to probably have a little bit more cash reserve need than a double income household. If you have more children, if you're paying for childcare, you probably want more cash reserves just to make your basic ends meet. So I really sit down and encourage people to sit down and calculate if you are going to be unemployed or in an inflationary environment, for 3, 6, 12 months, what would it look like? What would you need in order to maintain your cost of living, your standard of living during those months?
What about those who are already either marching towards retirement, have said, this is my date, I'm ready to be there, come hell or high water, by November or by October, maybe even earlier, they're ready to be retired? Or perhaps even those that are in retirement and you're seeing some of the effects of inflation kind of biting away at some of those savings?
Well, that is really a concern of a lot of my clients who are near or in retirement already. And we really want to focus on, at that point, assuming we've done the planning, and hopefully we've done the planning, we want to make sure that our expectations are flexible. Sometimes we can't control what happens in the world around us. So if we can think about, can we downsize a little bit? Can we reduce expenses? Another big one is really helping keep control over how much we give to adult children and how we spend in those ways on our discretionary expenses. So I think it's very important to change behaviors where needed, but really to have flexible mindset. Reducing debt's a big one, and sometimes going back to work is an option as well.
And then just lastly, since you mentioned going back to work, there are some people that are, freshly getting into the workforce. We're at college graduation season here, as they're setting themselves up and preparing a financial mindset for planning for the future. What is the number one thing that they can employ and as they're starting to hop into the workforce?
Well, there's so many. The first thing is have a plan. Yeah. Having a plan means that you're going to be able to calculate how much you need to save for the long term, how much emergency savings you have, and in other ways it's going to help you combat inflation over time. Making sure you are not accumulating any sort of debt, and especially credit card debt, which tends to really blow up during those inflationary periods. But having a plan, controlling your spending, have very good expectations or moderate expectations about your lifestyle at that point. So that way you are really on a saving and spending path that going forward will help you develop those emergency savings and combat this inflation going forward.
Kelly Smith, Edelman Financial Engines Financial Planning Director. Kelly, thanks so much for taking the time.
Thank you.
Certainly. Your golden years, well, hopefully golden here. A report on Social Security findings that trust fund reserves will go dry in 2035. And that means the pool of cash that Social Security pulls from will not have enough to pay 100% of benefits. For what this means for you and your retirement, we've got Yahoo Finance's very own Carrie Hannon here with more. Hey, Carrie.
Hey, Brad, great to be here this morning. Yeah, now, Social Security is clearly one of the biggest fears that people have when they look towards their retirement income. And is it going to be there for them? This is really, really top of mind for people. When this report came out, what it's basically telling us as of right now, with their calculations, you would get a 17% cut in benefits. So it's not saying it's going away, but you will get reduced benefits if Congress doesn't do something in the next, under 10 years. So for a lot of seniors, more than half of seniors, Social Security represents over half of their income. So this means a lot and is something that people really have good reason to be concerned about. They've been paying into it throughout their working lives.
And so how are financial advisors prepping their clients for a world with reduced Social Security benefits?
Yeah, absolutely, Brad. So I did a roundup. I called some of my favorite financial advisors and said, hey, so since the report came out, are you getting some calls from your clients? And yes, in fact, they are. And this is what they basically are telling them. Number one, let's plan as if you are not going to get Social Security at all. Now, that's probably not the scenario, but it's better to over-prepare. So they say plan that you're not going to get it. And many of them have already done this for their clients. Number two is to start saving and investing as early as possible with the idea that it might not be there for you. So I hate to be doom and gloom, but that's a good way to set your mindset. So a younger person should really be ramping it up as early as they can. And the third thing is, if you're nearing retirement and close to that time where you can tap into it, try to delay. A lot of people, especially now with all the emotions running around this hot button issue of Social Security and what's going to happen, they want to grab it as soon as they can at age 62 to start tapping their benefits. And frankly, many people may have to because they simply cannot continue to work because they're in physical jobs or have health issues. But if you can delay, and advisors tell me if you can delay at least to your full retirement age, which is generally around 67, or if you can push it to 70, you get the biggest checks possible for the remainder of your life. So it takes some patience, it's long-term planning, but as I said at the start, it's better to be over-prepared.
Certainly some very critical insights from your own reporting here. Carrie Hannon, thanks so much for taking the time here and bringing us some of the tidbits from those conversations you've been having as well.
Thanks, Brad.
Certainly. Coming up, everyone, sales, sales, sales. Memorial Day weekend is this week, and it's about more than sales, but we've also got an expert that's going to break down what you should buy or could buy for the big sales events that are going to be taking place and all throughout your feed. Unlimited shrimp deals for $20? Well, it turns out the Red Lobster deal may have been too good to be true. This weekend, the Orlando-based chain filed for Chapter 11 bankruptcy, citing high labor costs, rising rents, and yes, unlimited shrimp. In May 2023, the struggling seafood chain, which was seen as a 30% drop in diners since 2019, they announced that their $20 ultimate endless shrimp would become permanent, a disastrous move that ended up costing them $11 million. With inflation worries causing diners to eat out less, Red Lobster lost $76 million in the 2023 fiscal year. The restaurant's parent company, Thai Union, had been in talks with lenders to give up to 80% of the company, but the talks fell through. Lenders had infused $20 million worth of loans in February, but they were unwilling to contribute more without more support from the owners, according to court filings. The company, which employs 36,000 people in the United States and Canada, abruptly closed 93 locations last week. Well, in honor of Memorial Day and one of the biggest shopping weekends of the year, we know it is, consumers hunting for a deal out there. So what trends can we expect to see this year? Our very own Brooke DePalma is here with the latest. Brooke, what do we know on these deals?
Good morning, Brad. Consumers are expected to spend less, as you noted, this Memorial Day weekend than they did a year ago. So what exactly is behind that? Well, there are two reasons here. A pullback in consumers buying big ticket items like appliances and furniture, which sales during the 3-day weekend are traditionally focused on. And second, consumers seeking out value and discounts. Now, both of these combined are to blame for the slight decline in total spend. According to Retail Me Not, consumers will spend an average of $297 per person this weekend. That's actually down about 17% from where we were a year ago, and just how much consumers typically spent during this holiday weekend. Yet, consumers seem to be willing to stretch their dollar in order to celebrate this Memorial Day weekend. They're going to spend the most on categories like food and beverages. That's followed by clothing and apparel, dining out, party decor, and entertainment. Now, the last category on shoppers' minds, gardening and home improvement. And that's something we saw in Home Depot earnings results last week, that DIY customer pulling back and spending less on home improvements and gardening and other ways to make their home look better, that magical home renovation. But a majority of Americans do plan to skip out on shopping this weekend entirely. 34% say they will wait until Monday, though, in hopes to score the best deal. And so a mixed picture this holiday weekend, Brad. Back to you.
Fortunately, I don't have a lawn, so no lawn care or green thumb projects for me. But I got some interior plants, so I guess I'll be watering those. Brooke, thanks so much. So, if you are one of the 18% shopping this holiday weekend, what products should you buy and what can wait for the next big sale? Joining me now, we've got Adam Davis, who's the Wells Fargo Retail Finance Managing Director, here to break down just that. Okay, so what are the deals that are perhaps worth kicking the tires on or buying into over Memorial Day weekend, Adam?
Yeah, so typically, we're seeing some of the bigger ticket items, appliances, furniture, outdoor, indoor, as well as mattresses. And so those are kind of the big ones. But, what we'll see is retailers will start to sell through spring merchandise. And so you'll start to see some deeper discounts on some of the spring merchandise, in addition to some of those bigger ticket items.
What does that say then about the health of those inventory levels when you're looking at where the retailers are really comfortable slashing prices, clearing through or churning through inventory in order to make sure that they can perhaps be ready for the next wave of orders that they've already placed for later on this year?
Yeah, so it's important, for the retailers to kind of go from season to season. And so what they're doing is getting ready for summer. And, as you are thinking ahead, summer sales, they want to sell as much as possible at full price. And so you'll see some promotions this weekend for summer items, summer apparel. But as you get to the tail end of the summer, you'll see kind of deeper discounts on in-season items as they start to prep for fall and, holiday type goods.
Okay.
The extreme would be, think of a snowblower. Right now is a great time to buy a snowblower. If you try to buy one now it'd be heavily discounted. If you try to buy one after the first snowstorm or during the first snowstorm, it's going to be at a much, it's not going to be heavily discounted because it's in high demand.
So we were just taking a look on screen at what not to buy, perhaps, in this wave of sales that are going to be taking place in the next few days here. And I mean, we're looking at things like apparel, electronics, in-season goods. Why is that?
Yeah, so the in-season goods, they're going to be promoted this weekend, but not as heavily as potentially those big ticket items, which historically this is a big weekend for that. I think the other piece being retailers are going to try to clear through kind of that spring merchandise, especially like apparel. I think what you'll see is at the end of the season, that's where heavy discounts will come into play. I think, for grills and outdoor furniture, it's tempted to buy it. It's very tempting to buy now. I think it would be, if you have a specific item that you absolutely have to have, then, kind of shop around, kind of hunt, do some price comparisons. But if you are patient, are able to wait till the tail end of the season, you should be able to see kind of bigger discounts. On the electronic side, you'll see discounts, but what we have historically seen, heavier discounts around July, Black Friday, Amazon Prime Day, and then as you get into the fall with traditional Black Friday and Cyber Monday, those are just heavier discounts for electronics.
Okay, all right. That's some interesting calculus on where not to fall into the pits of the vibe du jour, if you will. Ultimately, as we're kind of considering now for consumers and where they're showing that they do have a little bit of propensity to still spend versus areas that they're saying, I'm gonna pull back. Where is that kind of looming heavy as we go into big sales events to kick off and even throughout the summer?
Yeah, I mean, the consumer is still shopping, right? And I think that what we've seen is the first quarter has been relatively muted or quiet. I think the good news is the retailers have gone through multiple waves over the last few years. And so they've been really thoughtful and about their inventory levels and not getting too deep, and supply chain has smoothed out a little bit. So you're not seeing the lumpiness that we've seen over the last few years. So with that, the retailers can kind of push in and pull out as it relates to promotions. Memorial Day weekend is one of the first big sales weekends for all retailers. And so you're going to see most of them participate. I think it's really, are they promoting store-wide, online for everything, or is it very specific targeted items that maybe they're trying to clear out, move, create room for new product, or is that an older generation item that they're looking to then later this year introduce the next generation of?
All right, Adam, I'm quite removed from my days of clipping coupons. However, there are quite a few deals to be had out there, so who knows? I might be picking up a circular. But for those who are looking across some of these deals, how should they be evaluating them, and what are the top tips to save when evaluating all of the different deals in the market?
Yeah, I mean, look, I would say loyalty programs are key. I mean, retailers love that information. They love pushing out those types of promotions. You'll be the first to know whether, a certain brand or a certain product's going on sale. So I think loyalty programs are big. Price comparison between the different retailers is big. And you could probably pull up kind of where certain products were on sale last year. And if it is a specific technology item, a TV or something along those lines, I think what you can do is look at what was on sale last year for Prime Day and during the summer, and when those brands ultimately introduce the next generation, because that's really where you start to see the heavy discounts. Other than that, it's going to be a promotional weekend, and I think this is kind of the unofficial kickoff for the summer. And so that is kind of that transition, and so you'll start to see more outdoor stuff, and I think that's where you're going to see that transition from spring apparel to summer apparel, and where you can find bargains is really going to be some of that clearance stuff on some of the spring merchandise.
All right, I saw the bottom tip on that graphic, which was be patient. Patience is a virtue. It's not my strongest one. Adam Davis, Wells Fargo Retail Finance Managing Director. Thanks so much for some of the tips and tricks for this big weekend coming up here. Thanks.
Appreciate it.
Coming up, ahead of their latest earnings later this week, Target has announced price cuts on thousands of items. We'll give you the details when we come back. In an effort to turn around sluggish sales numbers, Target will be cutting prices on 5,000 items this summer, with 1,500 items getting their prices slashed effective immediately. With the company reporting its latest earnings this Wednesday, our own Madison Mills joins us to explain why Target is making this move right now. Okay, what's the impetus behind this?
Well, they're noticing that consumers are starting to buckle under the weight of inflation and they need to do something about it. We're seeing the likes of Walmart having a very successful earnings print, bringing in consumers across the income level, which could be an indication that consumers are looking for better deals. Target wants to get in on that, and they're doing that by cutting prices on a lot of what we call the consumer staples, the things that you can't really go without. Your Clorox wipes, your Thomas bagels, if you're a fan of a non-New York City bagel here, Aveeno with your lotions, Huggies, cutting down prices on those items, and this will go up to 5,000 items. They've already cut prices on 1,500, and the company says they're going to be cutting back even more as we head into the rest of the summer. And said, again, shoppers can expect more bargains for July 4th and the back to school and back to college seasons as well. Now, what's interesting to note is that these price cuts come again as we are seeing additional kickbacks from Target to consumers. Those who are in the Target Circle Card program can get an additional 5% discount on top of the discounted prices that we're already seeing across these 5,000 items. So it's an indication to me that Target, I think there's a chance that consumers could get a little bit irritated by this because obviously it's good to have the price cuts, but at the same time, could they have lowered these costs months ago?
Right. Also, I have never tried Thomas's bagels. I've only tried the muffin, the English muffin. But I mean, it's coming at a time too where they're using this opportunity to promote ahead of Memorial Day weekend, summer sales, saying, hey, some of these everyday low items, whether it's red cups for those of you who are probably tossing some ping pong balls into it, or those of you who just need, an extra grill at home. Those everyday low prices that they're trying to talk about are also trying to promote the du jour of seasonality too.
Well, and it's also interesting, I forgot to note this, that Walmart is America's biggest grocer. So a lot of these price cuts coming in for food, that could be a potential move to compete with Walmart as well.
Absolutely. Maddie, thanks so much. I'm excited. TGT earnings coming up this week. There's much more there. Everyone, let's do a quick final check of the markets here as we're taking a look at the Dow, the S&P 500, and the Nasdaq. They're positive, starting off the day on a positive note here. We're taking a look at gains across the board. That's it for Wealth. I'm Brad Smith. Thanks so much for watching, and stay tuned. Market Domination with Julie Hyman and Josh Lipton. That's coming up at 3 p.m. Eastern Time. You don't want to miss that.